You know the story. It's all about earnings.
Equities are priced for perfection in a world that's not that perfect.
This is a very selective market. It is a stock picker's market.
The outlook still looks pretty bright.
We are at a sort of melt up, and we could have some correction along the way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, getting the best of both worlds. The US and Iran lining up a deal pushing stocks to record highs as Anthropic is raising money approaching a $1 trillion valuation. Guidance from Dow is crushing estimates, sending the stock surging. That stock up almost 40% this morning.
And honestly, it just underscores how much analysts keep underestimating how much cash is just flowing into the AI trade. When you start looking at the numbers for Dell, you start understanding the scope of the underestimation. The fact that they expect their full year revenue to be $167 billion, up from an initial outlook of $140 billion, which is roughly where analysts were. It gives you a sense of the outperformance that strips away all of our expectations on the spend. Two things. Either this is growing faster than we expected, or maybe it's getting a little too expensive for some companies to justify.
Just bring up Dow in the pre-market and show the dollar change. Check it out. We're looking at a $120 move in the pre-market. This was trading south of 120 back in January of this year. That's just today. The moonshots you're seeing across single names like Dow and old school tech firms, it's just amazing to witness.
As they demonstrate how they can fit into the AI narrative. For Dell, it's their server demand that absolutely is skyrocketing. For other places, whether it's Ford and the potential energy that they could provide to AI, or some of the Bitcoin mining companies that now are AI energy providers, it gives you a sense that AI is the new blockchain, or whatever the trend is, that gives you a sense of profitability. The fact is that the amount of money coming in, and I think Anthropic's potential valuation really underscores this, is just beyond people's imagination, which is why you can get a valuation of nearly $1 trillion, which is about 100 times some of their annual revenues now.
It's moonshots. Anthropic this morning, the most valuable AI company. When it comes to Dell, also, this is a company that recently landed a huge contract with the Pentagon, and actually before that, the president had said, go out, buy Dell. Well, you know, maybe on his stock vice, the president was actually happy. But when I think of things like Anthropic and Dell, they are not just these high flyers right now on the stock market. They are also becoming ever more so integrated into our industrial complex.
I talked about the best of both worlds, so that's the tech story. Check out crude this morning, down again. Down about 20% so far on the month. Brent crude negative by 1.5%. WTI 87 this morning. We're close to a 60-day agreement, which then starts a conversation about what's going to happen with the uranium, but should reopen the Strait of Hormuz. This reportedly is on the president's desk, and we're waiting to see if he signs it.
The market's not waiting, and that is the most interesting aspect. We might see the biggest decline in oil for this month going back to 2020. People are saying, okay, this is over. Maybe prices will remain elevated, even as the pros on the ground talk about the potential for shortages. I can't put together the idea of inventories. So diesel or refined distillate inventories in the United States are at the lowest level going back to 2003. We're talking about potential shortages and delays getting things restarted. And people in the paper market are saying, we've moved on. This is a non-story now. Resolve this because we don't think it can last.
It's a non-story at the moment, but at the same time, the president hasn't announced it. It is on his desk. J.D. Vance yesterday, the vice president, said we're very close, but the Treasury Secretary was briefing reporters and said the president will not accept a bad deal, and he has a number of red lines. And then the vice president was talking about how they're still going back and forth on some language issues. The hardest issue, of course, is going to be the enriched uranium. And at that moment, it doesn't look like they are making a ton of progress.
For now, crude down, stocks up, futures positive by 1/10% on the S&P 500. Coming up this hour, Max Kettner of HSBC with stocks on a 6-day winning run. The former Deputy National Security Advisor Victoria Coates as the US and Iran line up a deal. And Angelo Zino of CFRA as Dell absolutely crushes analyst estimates. We begin this hour with stocks looking to add to record highs following Dow's blockbuster earnings report. Max Kettner of HSBC writing the close to 100% EPS beat rate, coupled with strong forward guidance of the US tech sector in Q1, is cushioning the overall equity market. Max joins us now for more. Max, we've talked about it repeatedly. Max Kettner, Max overweight. And Max, we got into your danger zone at one point in this bond market. This market didn't blink. What gives?
Yeah, look, thanks for having me, John. I think the danger zone, for now at least, we can ignore it. We can ignore these higher yields because there's a couple of things, I think, happening over the last 2-3 months. We've obviously seen yields start to go up in treasuries in conjunction with that much, much better earnings season. You guys were just bringing up that tech had an almost 100% beat rate, so almost all of the companies in tech surprising to the upside. I would look also at the worst beat rate. If we look at telcos had an earnings beat rate that was just the average beat rate of the S&P in the 2010s. That at the moment is the worst beat rate across the sectors. That's how strong and how broad-based of a reporting season and of upside surprises we had. And that, of course, was cushioning really the equity market and risk assets overall. And that made us maybe care a little less about higher yields. The other thing that I would say is if you look at yield increases in the last few years, where we went into that danger zone, where yields really were popping a little bit too quickly, where the velocity was much more vicious, that actually was seeing volatility in rates way, way higher. When you look at the MOVE index, we've only spiked to around 80. In the last couple of episodes, we spiked to around 130, 140, even 180. Now the high was only at about 80 in the MOVE index. So that lower equity vol also really led to a little bit of less of a multiple compression. So to me, that is perfectly rational what the equity market spreads and the broader risk asset complex have done in the last 2 weeks.
Max, could you take it an additional step further? Do you think the forces driving equities right now are less rate sensitive and will be, even if this Federal Reserve becomes more hawkish?
No, I would take it one step further from your one step further. I think it's also the economy, right? Let's be honest. Let's say, for example, if 5 years ago I would have come on the show and would said, look, I think rates are going to go from 0 to 5.5 in record speed. And as a result of that, I think that non-financial corporates in the US, the net interest payments of those non-financial corporates are now going to dive to a 20-year low. I don't think you guys would have invited me back, right? I think you guys would have been like, well, he's a funny German, but maybe he's going to have to go back to university and study Econ 101 a little bit, and maybe we'll invite him back in a few years again. But that's what's happened. So I think we've, even in the economy overall, underestimated how less rate sensitive we are now, how companies have termed out maturities. Look at the S&P. Almost 2/3 of debt in the S&P now expires after 2030. Look at high yield. The maturity wall that we've got in high yield is less than 3% of the index this year, in the US in particular. When you look at the amount of triple Cs in Euro high yield, it's about 6% of triple Cs. That used to be like 10, 11%. In US high yield, just 10 years ago, that used to be 18%. Now it's only about 9% triple Cs. So even if yields go up, you know, credit is better quality nowadays. We don't have the maturity walls as much as we had in the past. We have companies, even higher rated companies, termed out maturities, locked in low coupons. You know, so rates really aren't this big danger anymore.
Max, can companies continue to make earnings like what they've been doing without some sort of participation with the form of wage gains or a much tighter labor market?
Yeah, I think so, because obviously most of the earnings increase that we've seen now has been very, very concentrated. And that, I think, is maybe going forward from a strategic, from a structural perspective, a bit of an issue, a bit of a problem, right? That when you look at the S&P 500, it's not really like we're investing in 500 companies. We're really investing in sort of 30, 40 companies. The first 30 companies is almost 2/3 of market cap. So, Lisa, when you're asking, can all of the 500 companies weather this? I'm not sure, right? When you look, for example, at the lower 100 companies within the S&P 500, I think we are starting to see management guidance, corporate guidance deteriorate a little bit. That's clearly what we've seen in our own analysis on company earnings, call analysis. Absolutely. The problem there is it affects more the companies that have a very, very low weighting in the S&P 500. Let's give you one example. If you look at the lower 100 or the last 100 companies in the S&P 500, so the last 20%, they account for a little more than 1% of market cap. So it's not all companies. Surely the smaller ones, they will probably struggle a little bit if, let's say, the 10-year goes to 5% and stays there. But for the overall market direction, that just doesn't matter.
If that's the case, Max, what would it take for you to actually turn less positive, less overweight?
I like that you said no, not bearish, because that will be a big hurdle to turn me bearish.
I won't get ahead of myself. Go ahead.
There we go. Exactly. No, I think the big issue is positioning. So positioning overall still is pretty subdued. You know, on our analysis, we don't really get a proper buyer signal nor a proper sell signal. Positioning, even from systematic strategies, it's not even at the 50th percentile yet. When you look at equity market participation, for example, it's not very broad, right? We know that it's mostly been tech and AI. Contrast last year, Liberation Day, the V-shaped recovery. The amount of companies in the S&P that are above the 50-day moving average, they popped from 5% to 85, almost 90%. Now we've gone from 20% above the 50-day moving average to only 50. So half of the index isn't really participating. I think if we were to get some more supportive news out of the Middle East, and then we get another pop, we get really sort of the rate-sensitive cyclical stuff participating, which I think is the next big trade. Your regional banks, retail, you know, things like home builders. If that starts to participate, I think there is a reasonable basis to say that's probably the very last leg then. Then participation rises, positioning rises, and after that, I think it's time to take a couple of chips off the table.
Max, there is one line that stuck out to me in your note, and it was that you doubt investors will fully embrace progress in the U.S.-Iran talks and instead point to lack of details to keep positioning low. Are you basically saying until we get a proper deal, which, Max, could take months, we're not going to see this rally broaden out?
No, that's not what I'm saying. I think progressively or incrementally better news, that actually means that incrementally I think people will give up on, oh yeah, I'm just long tech and AI, and I actually cannot embrace that broad-based earnings recovery that we've seen in the first quarter. I need to stick to that narrow set of stocks that have been working. Actually, I think over the next couple of weeks and months, we will start to realize, hold on, look at the last month and a half, for example. We've had activity data surprises in the US that clearly have been going up, so clearly improved. I think for now, people are probably reluctant to put those kinds of trades on because we had that rate sell-off, right? We still have Hormuz closed, so there are some sorts of worries in the background. But I think with time, we'll start to realize that particularly cyclicality in the US is much, much more insulated from what's happening in the Middle East than perhaps we thought 3 months ago.
Hey, Max, it's good to see you. It always is. Thank you, sir. Max Kettner of HSBC out of London. Still constructive on this equity market for good reason. All-time highs and a rally over the last 3 months. The strait's been closed for 3 months. The rally of more than 20% on the Nasdaq. Do you know what Europe's done? Nothing. Down about 1% over the same period. If
you take a look at some of the consumer cyclicals in the United States, it might look more like Europe. This is not a story about overall broad-based U.S. economic growth. This is an AI moonshot. And that's essentially being reflected in names that aren't traditionally AI moonshot names, but are managing to tap into the story.
Speaking of Europe, just to indicate and highlight how different the conversation is around central bank policy, we're having a conversation about dropping an easing bias before maybe we shift to a conversation about hiking rates. An ECB official just caught my eye across the Bloomberg terminal discussing the timing of the second rate hike before they've even got to the first rate hike, which might be a few weeks away.
Yeah, right now the market's pricing at an 89% chance that there's going to be an ECB rate hike in June, which would be their first going back to 2023. And going back to the conversation we've been having this week, central bank rate hikes usually are not done in 25 basis point increments, and then that's the end of the cycle. Usually it's a rate hiking cycle, which indicates how they really do have a primary focus on inflation and maybe not so much on growth, because we're talking about growth flagging, and yet they need to raise rates even though the U.S. is not. I mean, really, it's sort of by betting.
Constrained by a single mandate. You've said that repeatedly throughout this crisis. Equity futures right now just about positive on the S&P with an update on stories worldwide this morning. With your Bloomberg brief, Fonnie Quinn has more. Hey, Fonnie.
Hey, John. Good morning. The U.S. and Iran reaching a preliminary deal to extend the ceasefire by 60 days. Vice President J.D. Vance saying the two countries are ironing out details, with Treasury Secretary Scott Bessent reiterating President Trump's red lines on reopening the Strait of Hormuz and Iran surrendering its enriched uranium. Anthropic raising a fresh $65 billion in its latest funding round. The funding was led by several companies as well as Google and Amazon, who each contributed several $1 billion. The influx lifting Anthropic past its rival OpenAI's valuation for the first time. Dell shares extending gains in the pre-market. The hardware giant seeing an almost 40% surge in extended trading after its sales outlook, which just blew past estimates. The company seeing sustained strong demand for its servers that power AI computing. And that is your Bloomberg Brief. John.
What a move, Fonnie. Thank you. Up 38% in the pre-market. Up next on the programme, pushing for a peace deal.
There are a lot of details to work out. I think we're making progress. We're getting to a point where we could potentially sit down and settle these issues. We're not there yet, but we're very close and we're going to keep on working at it.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning. Six-day winning run in the equity market this morning on the S&P 500, up again by almost 0.1%. On the Nasdaq, just about unchanged, but closing yesterday once again at all-time highs. Tracking the latest, the bull parade. Check it out. I've counted 10 firms who have upgraded their price target on the S&P 500 over the last 3 months since this war started. Bullish and bullish why? It's the same response again and again and again.
I'm going to channel Bob Dole. Earnings, earnings, earnings. I mean, essentially everybody comes on and says that they've actually blown expectations out of the water. And you see it in a broad-based number of companies, not just those related to AI. But it turns out more companies are related to AI than they previously imagined. We're talking about Dell, we're talking about Ford, we're talking about Bitcoin miners that all have found ways to tap into the story, and spending still is continuing very strongly.
I'm not sure how comfortable Bob Dole will be with that impression of Bob Dole.
Well, no. Earnings, earnings, earnings. I was just sort of being, would you like to try?
It's not Santa Claus. In the bond market, let's turn to this. Treasuries, 2s, 10s, 30s. Yields lower for the last 6 sessions. On the 10-year this morning, that rally stalls at about 4.45. In the commodity market, crude, WTI and Brent. On the week, oil's down by close to 10%. On the month, it's down by close to 20%. Big retracement. Brent crude down to 92. WTI at 87. Under surveillance this morning, pushing for a peace deal.
There are a lot of details to work out. I think we're making progress. We're getting to a point where we could potentially sit down and settle these issues. But that requires us to make a little bit more progress. I can't guarantee that we're going to get there, but right now I feel pretty good about it. We're not there yet, but we're very close and we're going to keep on working at it.
So here's the latest this morning. The US and Iran reaching a preliminary deal to extend the ceasefire by 60 days. Sources telling us here at Bloomberg that the president has yet to agree to the terms. Bloomberg's Jemana Bassechi has been tracking all of this for us for the last 3 months. She's in London now. Jemana, welcome back to the programme. We're close. How close are we to signing this thing?
Yeah, it seems like we're very close. Based on our own reporting, you were just citing Bloomberg sources that we spoke to alongside Axios, various other news outlets reporting yesterday that Iran and the U.S. had agreed to a framework around this MOU that would eventually work to a full cessation of hostilities. And the sequencing here is important because from what we understand, the MOU would entail an extension to the ceasefire. That would be 60 days. And then a 30-day window for Iran to reopen the Strait with unrestricted access to demine the Strait fully. And in return for that, the U.S. would gradually then lift their own blockade. Now, also, in parallel to that, they would then begin the formal discussions around the nuclear file, which is essentially, the crux of the matter here. And Treasury Secretary Scott Bessent overnight once again reiterating what President Trump's red lines are. And he said that ultimately we have to go back to a situation where there is free flowing of vessels going through the Strait of Hormuz. But then in addition to that, Iran have to somehow either destroy or agree to give up their highly enriched stockpile of uranium and commit to not building a nuclear weapon. So back to the same issues that we were discussing pre-war, but those are President Trump's red lines. As you say, we have not yet got full sign-off from President Trump. We don't know. The ball is in his court right now. The Iranian President Masoud Pezeshkian posting on X that he, in return, is committed to diplomacy. So there has been a huge diplomatic push over the last couple of days. And one thing that I would say is slightly different from earlier attempts is this time around, you have a big push coming through from Gulf Arab states as well. Qatar have played a huge role in mediation efforts to get this across the line.
I think we're all wondering if you timed it this way, Jemana. Last day at work before maternity leave, wrapping up the deal between the US and Iran. Did she time it this way?
Yeah, I mean,
feels that way.
It does feel like she got great timing. She left the Middle East. She's going to go on maternity leave, and maybe the war's going to end.
Hey, Jemana, congratulations, and thanks for all the hard work. We appreciate it. We'll see you in about 6 months' time. Best of luck and all our love to Jemana and her family. To build on this conversation, the former Deputy National Security Advisor Victoria Coates writing the following: this is when we keep the pressure on. We make sure we get to the good deal the President outlined. I think we're going to see a tremendous drop in energy prices very, very quickly. Victoria joins us now for more. Victoria, welcome to the programme and welcome back, of course. Can you define for us what is a good deal? What does good look like in this moment?
Well, good morning, Jonathan, and best wishes to Jemima. That's really wonderful news. I think what we want to see here is a verifiable deal to get to the president's red line, which is no nuclear weapon for Iran. That's the basic premise under which this entire action has been taken. This is an intolerable threat to the American people. We've seen how the Iranians behave. Too much of a chance they would use a nuclear weapon if they got one. And they've been pursuing one now for about 20 years. So it had to end. So that deal where they give up the nuclear dust, then they also open up the Strait of Hormuz. They stop holding the global economy hostage, which is what they've been trying to do. You know, we get that energy flowing freely again. Then, and we don't give them sanctions relief in advance of that. That's a good deal. That is what keeps the American people safe.
Victoria, the New York Times has reporting that there's this idea of a post-war investment fund, and one diplomat put it at $300 billion. Does that sound right from a president that has continuously gone after the Obama administration for the JCPOA and the relief the regime got?
Well, I think this is a separate issue, Annmarie. I mean, I think after the war, the rebuilding of Iran will be of great interest to a number of investors if they have leadership that is in any way reasonable and normal. That was the problem with the JCPOA, because if you remember, the Obama administration really leaned into trying to pressure American companies and European companies into investing in Iran, and nobody would do it because money essentially is a coward. You don't want to go into a dangerous situation with an irrational regime. So all of that, you know, would be on the table. It would be hugely lucrative to rebuild Iran. I would love to have that happen under normal circumstances, but they would have to have very, very different leadership to make that in any way viable.
But there were companies that decided to go in, like Total Energy and some of these other companies. And the regime is intact right now. So we'd be giving money to the same sort of people, no?
I just don't think it's viable under this regime. I mean, we tracked what went in under the JCPOA, and that was de minimis. I mean, there were a couple of Chinese companies that went in, but that was not the inflow of investment that Iran anticipated would come from that deal. And I think those circumstances would still be in place if you have a hostile regime, you don't have the rule of law, you have the arbitrary cutting off of the internet, shutting down of the stock market, all the things they've done over the last 90 days. You know, it's just very hard for me to see this massive investment happening under those circumstances.
What are the obstacles, Victoria, for potentially President Trump not signing off on this deal?
Well, I think it would be if the Iranians can't organize themselves to commit to the terms. And that's the other problem we have here, is the leadership is quite fractured. I think it's interesting that President Pezeshkian is, you know, coming out with statements that he's committed to diplomacy. If he can actually make a decision, if he has the power to do that, you know, that's encouraging. But we have to wonder what the IRGC is up to, whether they're going to continue trying to mine the Strait of Hormuz, whether they're going to continue to try to fire off missiles at partners and allies like Kuwait. So I think the president rightly has time on his side. He is showing clearly he's not desperate for a deal. He's not chasing after the Iranians. I think he's letting them chase after him.
Victoria, appreciate it. Watch this space. We'll catch up more, no doubt, in the next week or so. The former Deputy National Security Advisor, Victoria Coates, on the latest in the Middle East. I want to be very careful not to define whether this deal is good or not based on what happens with crude. We talked about the word agnostic yesterday. This market, in the short term at least, incredibly agnostic to why crude is flowing or not. It doesn't care what the deal looks like. Just get the energy moving through the strait. If we achieve that, great news in the short term. Over the longer term, then you get to talk about the details and the nuance of that, and then we can talk about whether it's a good deal or not.
Yeah, Victoria was saying money is a coward, which is a line that I wrote down. Money right now is not necessarily good or bad, virtuous or not virtuous, when it's taking a look at the nuts and bolts of is oil flowing, and essentially that's the vote that you're seeing right now in markets.
And we've got another boost, another pillar, the main engine of this equity market is tech. Up next, Angelo Zino of CFRA following Dell's blockbuster earnings report. That stock in the pre-market absolutely flying. Let's start with crude. Good place to start. Crude down this morning, down on the week, down on the month. We're negative by 1% on both WTI and Brent. Let's think about where we've been over the last 3 months or so. The Strait of Hormuz has been closed for 3 months. Crude over that period is up by more than 30%. Check out the bond market. Change in 2-year bond yields. 2-year yields at the front end of the curve, higher over that period by more than 60 basis points. So you've got crude higher, you've got yields higher, all of this over the last 3 months or so. And you'd think, okay, well, equity markets must be getting crushed. All-time highs. Over the same period, the S&P is up by 10%. The Nasdaq is up by more than 20. The chip stocks, the semiconductor index, Philadelphia, the one we often say, up by more than 50% over the same period.
It's a really important point because it really raises two tensions right now that need to be resolved. Either the stock market, the bond market, and the crude market are on completely different pages as far as ramifications, or this economy has changed fundamentally. And you heard Alberto Muslim of the St. Louis Fed talk about this, that potentially the neutral rate is significantly higher, and potentially we're talking about a much faster growth economy in an AI world that is independent from rates that we're seeing at these levels. That is a reality that poses a real issue for the Fed and, frankly, for markets in terms of what inflation really looks like and how fast growth can contain.
Do you know what energy stocks have done over the same period? Down 1% on the S&P.
Yes.
Who would have made these calls at the start of March?
I mean, the less you know. I mean, honestly, I came in this morning and I was thinking to myself, I might as well have slept through the month, because at a certain point, you can't predict what actually was going to happen based on the facts and the headlines.
Amazing 3 months. 3 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing a massive upside move in Dell shares. They are soaring nearly 40% in the pre-market after the company raised its full-year outlook and said it expects AI server revenue to reach $60 billion next year. And it's not just AI servers. Dell also saying that demand for its traditional CPU-powered servers is also taking off, helping to justify that this is broad-based and sustainable. So that is helping to lift peers, with shares of HPE and Supermicro also soaring. Turning to the PC maker, HP, those shares are rising 5.5% in the pre-market as the company benefits from a wave of PC upgrades as companies look to take advantage of AI. But that demand, of course, is coming with a cost, with HP warning of rising memory costs that is starting to crimp profits. So while the profit outlook did come in ahead of estimates, it did miss the most bullish projections on Wall Street. And we end on Gap, those shares absolutely plunging down 16.8% in the pre-market after it cut its full-year outlook. A setback for CEO Richard Dixon as he tries to turn around this sprawling retailer. The notable miss came from Old Navy, which makes up about 60% of the company's sales. And Dixon is not taking the out. He is not blaming the consumer. He says the company simply did not get the fashion assortment right when it came to key seasonal categories. John.
Yahara, thank you. That's leadership. Love that. You're catching up with them later. I think that's great. It's easy to blame what's happening with energy, easy to say the consumer squeeze. Just say we got it wrong. Execution. That's what it comes down to.
It comes down to dresses that were not at the right price point for the value they were getting. That's how he phrased it, and potentially Athleta. What's interesting is it's not just them, right? We also saw this at other stores also saying they had misses, whether it was some of the other competitors, because of style, not necessarily the economy. It's an interesting kind of distinction. Does it give them more potential to beat on the second half of this year, or is it just a reality check? Fashions move very quickly. People in the Insta era have a very different experience of fashion.
Credit to him. You'll be catching up with him a little bit later this morning. Look out for that. Bramo catching up with the Gap CEO later on this morning. On our radar this morning, the US and Iran reaching a tentative deal to extend the ceasefire by 60 days. Key sticking points remaining unsettled, including the Strait of Hormuz and Iran's nuclear program. The president reportedly taking a few days to consider it. Elsewhere, SpaceX is cutting its valuation target for its highly anticipated IPO. Sources telling Bloomberg the company it's now aiming for a $1.8 trillion valuation, down from above $2 trillion. Still on track for the biggest IPO in history. And finally, Anthropic raising a fresh $65 billion in its latest funding round, lifting its valuation to $965 billion. Google and Amazon each contributing several $billion, with Anthropic passing its rival OpenAI's valuation, for the first time.
The amount of money here is mind-boggling. Talk about $65 billion of money raised. If you look at SpaceX, which is going to have a valuation of $1.8 trillion, according to the latest reporting, as you were just saying, they raised $75 billion. Their goal is to raise $75 billion in that equity offering. The amount of money being raised and poured into these companies that keep beating and accelerating on earnings is mind-boggling. Here are the hang-ups, and you can see this nervousness starting to percolate into the conversation. What if companies are sick of paying so much for some of these services? What if companies start to push back and say, you know what? You could stop vibe coding your kids' homework. Maybe don't play around, create some sort of meme that's going to go on X. Maybe pull back unless you can prove its productivity. Does that pose a threat to the meteoric rise that you've seen in some of these companies?
And what's interesting is these companies have now become really part of the U.S. government, not just in a defense industrial base, but also, at least when it comes to Anthropic, they're for the moment being allowed to use across other agencies. We talked about Dell earlier. They inked something with the Pentagon, which is why I find it so interesting that Anthropic right now is the most valuable AI company, even though the Pentagon says it is a supply chain risk, a designation you would see for something like a Huawei.
You know, it's funny, not just the US government, increasingly they are the US economy. You mentioned Dow. Let's talk about Dow soaring in pre-market trading after raising its full-year guidance. The CEO, David Kennedy, the CFO, telling Bloomberg that confidence and demand for its servers continues to grow.
It's a tremendous start to the quarter, obviously, in the year ahead, built on real, durable, and accelerating globally the amount of infrastructure that's needed out there. So really more broad-based and, AI demand, if you like, beyond the GPU in terms of the opportunities ahead.
Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, the move is amazing. The numbers are ridiculous. The price gap, the gap up we're seeing this morning in dollar terms is more than what the stock was trading at the start of the year, Mandeep. Can you just put that into perspective for us? What kind of valuations are these companies at right now compared to where they were to start the year?
Look, I mean, when we track the CapEx expectations from the start of the year to now, they've gone up almost, 30, 40%. And so from that perspective, everyone believes now that the normalized CapEx for cloud companies, it used to be around $200 billion. It's probably north of $500 billion. And this year we are talking about maybe potentially $1 trillion in CapEx from the hyperscalers. So when you map the trickle down of that CapEx to server makers like Dell, it doesn't surprise me that they beat their estimates by 20% because, the analysts didn't keep up with, all the positive revisions that we are seeing in the CapEx. And right now you're seeing that really materialize in a big way across the board, whether it's memory names, server names, GPU names, and that's the source of that is all the CapEx increases that we are talking about.
Mandeep, they're the major beneficiaries. We can pick out the bottleneck, pick out the names. You can see these moonshots here, there, and everywhere. Is there any pushback to the CapEx? Any pushback whatsoever? Any weakness emerging that's notable for you?
I mean, look, the technology is quite expensive, as you guys are alluding to before. Like, for some of the tasks, it doesn't make sense because, at the end of the day, no one wants to take a margin hit. Jensen says, I want to maintain my mid 70% gross margin. Memory guys are raising prices. The cloud companies are maintaining their costs and they don't want to take a margin hit. So who ends up paying the price for this compute, which is quite expensive? And I think it's going to be that end customer. And at some point, they will realize, for certain tasks, it doesn't make sense to use AI. We haven't reached that point yet. We are right now in that point where everyone wants to hoard compute. They want to make sure they're not short of compute in any way. There is double ordering going on. But at some point, we will be talking about that in terms of what is rational, what is normalized. And that's when, things will start to temper down.
Mandeep, it's good to see you. It always is. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. To build on this, Angelo Zino of CFRA writing, we continue to have a positive, fundamental outlook on semiconductors and hardware, driven by the AI infrastructure build-out and massive earnings power. Angelo joined us now for more. Angelo, I just hear the same thing repeatedly. Earnings, earnings, earnings. Is there a risk of normalizing the irrational, so to speak, given the moonshots we're seeing developing across single names at the moment?
Yeah, so John, and thanks for having me. So when we think about, I guess, the earnings power in this market, I think we're clearly seeing some sort of a reset higher, right, in terms of just the magnitude of the CapEx increases. we're seeing from these hyperscalers. And I think right now the street's really trying to sniff out where the greatest earnings power is coming from. And I think we've got a pretty good sense here just going through Q1 earnings season of where that earnings power is coming from. And obviously you've seen, the respective move in those stock prices, given the fact that you're seeing, pricing increases from those companies. And that's also translating to that higher earnings power. I would say, as you kind of look ahead, we think there is some sustainability, or we do think there is sustainability in terms of the reset higher from these hyperscalers. And as a result, you've got that sustainability once you kind of get this leg up in the earnings power. But maybe to your point, in terms of the normalization or earnings growth normalization, that's going to start playing itself out probably as you go into 2027 and 2028, because you're not going to be able to have these hyperscalers continue to increase CapEx on a 100% basis year over year. But you'll probably be able to continue, at least in 27 and into 28, see increases of, let's call it 25 to 30%, as long as you get that, cash flow from operations continue to grow, which at this point in time continues to be our base case.
The issue for a lot of people is that companies won't continue to pay these massive billion-dollar costs for the AI tools that they're getting unless they can prove some productivity. And we're getting to that point increasingly where executives are pushing back and saying, please stop just experimenting with it. Start actually using it to prove why it's worth its money. At what point do you have to see the real economy catch up a bit to some of these big tech behemoths in order to keep the streak going?
Yeah, I mean, listen, I think we're starting to see some of the AI monetization themes play itself out, which is really what's getting the market excited at this point in time, right? I think you look at an Anthropic and you potentially looking at a $50 billion run rate by in June on an ARR perspective, and continuing to go up. Really at this point in time only limited by their compute. But we're seeing the use cases. We're seeing we're seeing a lot of these pilot use cases go into AI production mode. I mean, you just saw Salesforce report this week, and you kind of see the usage rates really go up significantly just on a quarter-over-quarter basis. We think that continues into the second half of this year. So enterprises are adopting this stuff. You're seeing those use cases go up. And as a result, as long as we continue to see what we're seeing from a company like Anthropic, and only continue to be limited by the compute availability, I think this AI infrastructure build theme continues to work here.
Is Anthropic eating OpenAI's lunch?
It looks like it, right? I mean, you kind of look at the headlines at this point in time. Clearly it seems like Anthropic was right to focus almost exclusively on the enterprise side, and you kind of look at just the tools that they've come out with at this point in time, the focus more on security. I'd say you kind of look at where the enterprise space is really gravitating to, and it looks like, yeah, I mean, Anthropic is definitely winning here over the last kind of 2 to 3 quarters. And again, I mean, it's still early days, and I wouldn't necessarily count OpenAI out. But at least at this point in time, yeah, I think Anthropic's been the clear winner here over the last couple of quarters.
That's certainly the direction of travel at the moment. Angelo, thank you. Angelo Zino there of CFRA. To Angelo's point, let's not draw any conclusions too quickly. Last year, people counted Alphabet out and look at Alphabet over the last 12 months, but that's certainly the direction of travel at the moment.
Yeah, ChatGPT really skyrocketed the whole story of AI, and OpenAI was the ringleader. Now, all of a sudden, Gemini is a real competitor, and their professional tools, their security tools, haven't kept pace, at least not in the public's eye, with Anthropic.
That's the latest on tech. Let's get you the latest on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Apollo and Blackstone working to bring additional investors into a roughly $36 billion debt financing deal to help Anthropic build out its AI infrastructure. The debt will be used to purchase Google's custom chips as Anthropic races to line up that IPO later this year. Blue Origin's New Glenn rocket exploded in a massive fireball during a test on a Florida launch pad. AI personnel, all personnel, have been accounted for and are safe, according to the company. CEO Jeff Bezos says the cause of the explosion is under investigation. Bank of England Governor Andrew Bailey says allowing inflation to run above the central bank's 2% target is justified. Speaking at the Reykjavik Economic Conference, he cited uncertainty about Iran's war and the impact on the economy. That's your Bloomberg Brief. John.
Hey, Vonnie, thank you. I want to get in on this conference next year. Reykjavik, Iceland.
Yeah.
Everyone seems to be there, Bramo. Happening right now is the Kansas City Fed President, Jeff Smith. He's speaking at that conference in Iceland. He said just moments ago, the Fed must signal a commitment to price stability, which is intriguing because they've missed their target for much of the last 5 years and still retained an easing bias. So is that going to change in the next few weeks?
It seems like there's not an incredible groundswell to support the easing bias. Whether they actually have an inclination to hike is another story, and we have heard a bunch of Fed speak, raising questions about how high the bar to actually hike is.
Up next on the program, is a rate hike on the table?
We're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero.
Up next, we'll catch up with Lindsay Rosner of Goldman Sachs, live from New York City. You're watching Bloomberg TV. Equity futures right now up 0.1% on the S&P 500. Another close at all-time highs in Thursday's session. Friday morning up another 1/10 on the Nasdaq. In the bond market, yields behaving. 2s, 10s, 30s, 10s over the previous 6 sessions lower. Yields this morning just about unchanged. 10s at 444, encouraged by a big move down on crude on the week and on the month. Down on the week by about 10%, on the month down hard. The biggest monthly decline potentially since 2020.
Although you're not seeing the commensurate move in bonds that you would expect should you really buy that this is a sustainable story. So either the bond market saying we don't buy it, or the bond market saying we don't care, we're focusing on other things, because guess what? Volatility has gone to sleep, and we're looking at a longer term story that looks a bit more inflationary and stably so.
And maybe not just about energy. And I think you're touching on the right theme right now. Maybe this goes beyond energy, and maybe this story continues a conversation this Fed needs to have about just where neutral might be in this new regime at the Federal Reserve.
And whether AI really is the disinflationary force that everybody says it's going to be.
Under surveillance this morning, is a rate hike on the table?
We're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two. And in that scenario, the economy will probably require a hike.
So here's the latest this morning. Inflation concerns fueling growing warnings from Fed officials. Lindsay Rosner of Goldman Sachs writing, the Fed's focus for the time being is likely to remain squarely on policing the remnants of tariff pass-through and new shock from the conflict in the Middle East. Lindsay joins us now for more. Lindsay, good morning. Good to see you.
Thank you.
Let's start with that bar. How high is that bar for a rate hike of this Fed?
Yeah, I do think it's high. They have all the time in the world to wait. I don't think there's an expectation that it's next meeting or the meeting after that they need to do anything. I think the market's gotten very comfortable with a hold for now. But hiking, as we experienced in 2022, didn't go so well. So I think back to how high the bar is, like we kind of don't want to repeat the mistakes of the past, and thinking that hiking somehow changes how many boats go through the strait, it just doesn't.
There's something that you said about this not being the pre-COVID playbook, that things have changed, stay invested. Does that line apply right now?
It absolutely applies. I mean, just think back. You started off with a few stats of just how quickly we've moved, how much oil has moved lower, how much yields have now moved lower off of seeing the highs that we hadn't seen in a very long time. You can't play these zigs and zags. It's too hard to move a total portfolio. I'm happy to say we did add some duration when we got past that 5% mark. That was a good move. But to think that you can move your portfolio that quickly, it just doesn't work anymore. So you're supposed to stay invested. And when we look at the Bloomberg Barclays Ag as a good proxy for what's going on in fixed income, there were moments in there over the past month that we had a little bit negative total return for the year. We're back to positive. So just stay involved and look how your equities have done.
Is that the reason why volatility has essentially gone to sleep? Is everybody else just asleep because ultimately it hasn't paid to move around too much?
Yeah, I think that's a good point. It really hasn't. The transaction cost, the friction, would just chop up your total returns. I think volatility has also come down because if you look at actual delivered, right, smooth it out a little bit, it hasn't been that much, and that's where that number comes from if you look at the MOVE Index or if you look at the VIX. Specifically on equities, I mean, we've just marched. And when you march in that kind of movement, that's not really volatile, right? That's the rate that you have an expectation of move. So no surprise that the VIX is at 16 today.
Right now, I'm looking at where risk could potentially be building, because that's what I do in my free time. And I'm thinking if it's not necessarily in the bond market based on the move and based on what a lot of people are saying, the investment grade bond market looks like it's increasingly levered both to the duration story as well as the AI story. And I just wonder how nervous that's getting people given how narrow spreads have gotten.
You're right. It is levered to the AI story, the hyperscalers, tremendous amount of issuance this year, expectation is a tremendous amount of issuance next year. And by the way, the year after that it's not ending. I think it goes back to just thinking about all-in yields. And those all-in yields, maybe those spreads are tight, but those all-in yields are more attractive than anything we've seen in a while. So it's important to mind what is happening. And that's why I think going forward, there can be some opportunity for dispersion, and that you want to make sure you've got the right names.
Could we go back to your comment on a hike will not open up boats to go through the Strait of Hormuz?
Right.
So if the Fed were to hike, they would really need to see inflation entrenched elsewhere. Are you seeing that? Are you seeing it sticky elsewhere?
No, we're really not. I think there's interesting, if you unpack the numbers, like we just got PCE, which is what the Fed likes to look at. And one thing that seemed to pop up was housing. Housing looks like it was a big move, month over month. Well, got to remember, housing comes in at a 6-month clip. 6 months ago was October and the government was shut down. So the reading for housing literally was 0 because there was no reading. So I think if you really unpack the numbers and don't get surprised by the top, you'll actually find that inflation is actually benign and fine right now.
You said something interesting about all-in yields. I just want to follow up on that. It's a conversation we've had a few times on this programme. So you've got spreads tight, but
Yes.
all-in yields high. So you've got a big component of that is the risk-free, and then on top of that is the credit risk, OK? But this isn't interesting to people. This is. I'm intrigued by that. Why are people more intrigued by the all-in yield that you get from a corporate than this big, fat risk-free rate that you get from a sovereign?
Yeah, so the all-in yield is what you eat. It's what you take home. It is predominantly, to your point, from the risk-free rate. With spreads being so tight, what would concern you is if you feel like that story would change or there's something out there that would cause spreads to widen. We just don't see it. We just went through a remarkable earnings season. As you were talking about earlier in the program, anyone who wants to issue right now, not a problem. People are lined up out the door. So it's just a solid market right now, and the economy is in a good spot. We are, of course, predicting and trying to forecast, let's say oil stays in this precarious place and the tentative deal doesn't work out. What could that possibly mean? We think that shaves maybe 0.5% in a less nefarious scenario off of GDP. Maybe at worst, in a severe scenario of no oil through the Strait for a continued period of time, it shaves 1%. We think that's a small probability on the latter. And in general, we're in a good space that we can weather. I mean, you just saw that the consumer keeps consuming. That came out yesterday as well.
Lindsay, it's good to see you.
Thank
Appreciate
you.
it. As always, Lindsay Rosner there of Goldman Sachs. Lindsay said it. I'm always looking for potential capital constraints. Right, where's the pushback? Not seeing it. Anthropic's still raising money. They're about to go for an IPO. They probably don't need to. Just raised $65 billion in private markets. So equity side of things is fine. Credit side of things, all that issuance has come to market. It's got away just fine. I don't see any pushback or capital constraints, at least not yet.
So I was looking at that extra yield over the risk-free rate, and risk-free with an asterisk around it.
Well, precisely, that's what I was getting at.
Yeah, of course.
Yes.
It's 72 basis points, right? So it's less than a percentage point of extra yield. Given the fact that that's attractive, to pick that up over the risk-free makes me ask the question, who would you rather lend to, Microsoft or the U.S. government? And suddenly are people saying, actually, Microsoft doesn't look so bad?
Tells me more about the sovereign than it does the corporate.
Absolutely.
At least for now, at least. Coming up on the programme, we'll catch up with Alex Altmann of Barclays, the Chevron CEO. Mike Wirth joins us as well. Looking forward to that conversation, all of that in the next hour.
Don't get too caught up in the headlines. Stay focused on the data.
The real problem, it's inflation.
We are moving in the wrong direction, away from 2%.
The inflation data has been very hot and very sticky.
The outlook for inflation has become much more uncertain than it was.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now on a 6-day winning streak on the S&P, about to make it week 9. 9 weeks of gains on the S&P 500, record highs, up another 0.1% this morning on the S&P, on the Nasdaq up by 0.13. In the bond market, yields have been declining all week. Through to this morning, 10's unchanged, 444.73, encouraged by crude declining, down on the week by something like 10%, on the month by close to 20. Brent, 92, WTI, 87.
The move to me highlights how much people want to move on. And I know that I sound like a broken record. Maybe I'm just projecting. But ultimately, it seems like even before we get this deal signed, people are embracing it and saying it's wonderful, even though there are some serious sticking points. Right now, I think it's interesting. After Lindsay Rosner was speaking, it makes me want to go home and go to sleep, not because I'm tired, but because ultimately any kind of trading has not benefited anyone on real news. And that's the reason why you're seeing volatility indexes actually come down. To the extent that they're going up in the equity market, it's because people can't get upside quickly enough. It's not because people are worried about the downside. So people are looking at AI, they're looking at earnings, looking at the likelihood of a deal, and they're saying buy and then have a nice weekend.
Well, if we're on the precipice of a deal, that of course is going to be good news. But then the real work starts. Remember, the JCPOA took 20 months. Basically 2 years to negotiate. So this is going to be a very long timeline. On top of that, though, one good news that the Treasury Secretary yesterday briefing reporters said that 2,000 ships are waiting to come out of the Gulf. So if the Strait of Hormuz was actually going to open, very quickly you're going to see barrels hit the market.
It's been closed for 3 months. Nasdaq's up 20%. Semis are up by more than 50. Dow doesn't care.
That's a different story, Jonathan.
Totally.
Earnings.
Dow doesn't care. Down in the pre-market right now, up by 37% after absolutely crushing analyst estimates after the close yesterday.
The beats are sort of shocking. It's one thing to beat by, $10 million or even $100 million, but when you start beating by $27 billion in terms of your expectation for the full year earnings, it gives you a sense of why people are changing their expectation, their forward look of the valuation of this company. Dell makes things like the monitors that you put in your homes, not exactly sexy and hot, although AI has been really the driver given the fact that they are a server provider, and that has been sort of their moonshot right now in the AI world. The gains that we've seen are incomprehensible, and I just wonder how long companies want to keep paying for this. And right now the answer is they want to keep paying for it and then add to that, and that's the reason why people are betting on this story.
I'm just laughing repeatedly at the dollar move in the pre-market on that stock. The low of the year is 111. It's up by more than that in the pre-market. It's crazy the amount of market cap these companies are adding just in single sessions off the back of earnings that analysts can't keep up with at the moment.
That's the key. The fact that analysts cannot even comprehend how much these companies are making. The idea that their full year revenue will end for 2027 will be $167 billion versus the $140 billion estimate gives you a sense of just how much they're outperforming.
You know what makes me nervous? Keep asking the same question. What's the bear case? Just offer me a credible bear case right now, and everyone's like, no, not got one. Earnings. Right, that makes me a little bit nervous.
Yeah, well, I mean, I'm always nervous right
now.
Well,
I know that.
That's very
I've
much
always got company
nervous.
when I start feeling that way.
There always is a sense that inflation is one of them, a rate hike, if they actually were to execute them. What happens if companies actually stop spending as much as they have been? There are a bunch of different bear cases, Astrid.
Coming up this hour, yeah, that's one. Can think of some others. Alex Altmann of Barclays, as stocks push towards a 9th week of gains. Bloomberg's Tyler Kendall joins us too, with the US-Iran peace deal on the table. Plus, we'll catch up with the Chevron CEO, Mike Wirth. Looking forward to this, with crude on track for its biggest monthly decline since 2020. We begin this hour with stocks trading at record highs. Alex Altmann of Barclays writing, there is no obvious hard negative catalyst on the horizon that would unequivocally wrong-foot bullish investors at present. Alex joins us now for more. Alex, good morning.
Good morning.
I knew that was coming, which is why I said it. So let's get into it. Does that make you nervous?
Well, I think that statement was taken out of context because actually...
Well, give us some more context then.
That was part of actually a relatively cautious note, if you actually recall. And that was effectively within the context of, yes, that all investors that we talk to say, but the earnings, but the peace deal or the protracted ceasefire, whatever it may be. And yet we run a sort of a quantitative framework to try and sort of at least provide a sanity check to the path of equities near term. And right now that's basically flashing one of the most cautious readings that we've seen since the summer of 2024. And if you remember what happened, we had a pretty precipitous 10, 12% drop in equities then.
Conversations that you're having with clients at the moment, what do they sound like? Are they bulled up as these prices indicate?
I think by definition, the fact that you're having prices move this much illustrative, no. You don't have this much larger jump in markets if people were positioned as such. However, you are seeing pockets of positioning that's now clearly adjusted quite dramatically. I think one of the biggest evidences of that is you've had a rise in this, what we call spot vol correlation. So as the market's going up, volatility is rising with it. And that's sort of indicative of a chase and reach for upside to try and adjust that positioning.
What does cautious mean for you? I mean, is it essentially to sell, or is it just to bite your nails and take a long sleep?
our personal view is to hedge. So right now, what's happened is because those call options, because the reach for upside has been so dramatic, the puts are trading actually very cheap. So for context, if you were to just look at a swathe of different indices in the US market right now, whether it's, obviously NASDAQ and Russell and S&P, but also looking at things like semiconductors and even like Korea and the ETF, and to sort of hypothetically say, all right, let's say we had a 50% retracement of that move that we just had. Don't think that's the base case, but just to sort of think about it, how much would that cost to protect if you were to buy a put that struck at that? And right now, it's incredibly cheap. For S&P, for example, so that would be equivalent to maybe a 5-6% move, something like that. It would cost you only around about 13 basis points to protect all the way out to July. So we're effectively advocating, say, like, you've got a lot of gains, hopefully, and it's actually a good opportunity. You should be hedging when you can, not when you have to.
It's interesting how you hedge, because the potential risks are kind of on polar opposites of the extreme. You could either have a slowdown in the economy, which we could see next week with the jobs data, or you could get some sort of reacceleration that would prompt the Fed to hike rates, which would be another scenario on the opposite side. Which is the more important scenario to hedge against in your view?
Well, I actually think it's the slowdown risk, because if you look at the way the market's pricing right now, the market's digesting the fact that the path of the Fed is not clearly a easing bias anymore, right? So if you look at just Fed futures or SOFR futures, we're pricing in a hike, more than a hike now. So the equity market, I think, has processed that. So it's really the slowdown risk, which I think is the bigger tail right now.
As the equity market tests the new Fed chair, do you think we're going to see a drawdown?
So, with something we've talked about in the past, a bit of a loaded question. We've written about this quite extensively, and I think the answer is quite possibly.
I know what you're going to say. No, you put numbers on this, and I think about it's 12%.
Yes, so on average. Now, we've taken data back to the 1930s, so you don't want to sort of maybe make the argument it's not a comparable situation. We also have got some exogenous events in there. For example, when Greenspan came in, you had the crash within basically a few months of that. So, but even if you rip those out, those sort of real left tail events, you're still looking at a mid to high single digit drawdown within the first 3 months.
Have we got space for a low value rant? Can I just squeeze one in, just on the Federal Reserve? I find it so strange the way everyone's changed their view of this Federal Reserve. Now Chairman Powell has stepped into a governor position and Kevin Walsh is stepping in. Where was the criticism of this Fed a month ago, following the meeting, when they had the easing bias they've still got? And it seems like it's ramped up now that Chairman Powell has stepped aside and Kevin Walsh is stepping in. I find that kind of strange. I've got all these different columns that I've been reading at the moment. Let's take Bill Dudley, and forgive me, Bill, for picking out one name. But the column that he wrote for Bloomberg Opinion in the last week about incoming Kevin Walsh and not really having an argument right now to reduce interest rates, where were these columns over the last several months, the last 3 months? Where were they? And where was the pushback in the news conference from the journalist not asking enough questions about that easing bias, at least for me, and subsequently to Fed officials too? And I think you've picked up on a really good point, and this is what I'm getting at now. If you get to interview a Fed official right now, ask them the question that you asked earlier this week. Everyone needs to ask it. Who supported the easing bias at the Federal Reserve? Because we can't find anyone that supports it now, just as Kevin Walsh is about to step into the seat. At the same time, Chairman Powell was maintaining it at the last news conference.
To take that a step further, and I think it's a really valid point, what has changed between then and now? Have the inflationary pressures gotten that much more significant? Are we seeing the earnings coming from companies somehow shading the view of officials, or are they just sort of digesting the public commentary and chasing the market activity? These are, aside from the political question as well. But that, to me, you really have to ask, how much has actually changed?
Well, I think that the political question is perhaps the important one. People seem to be more critical of Kevin Walsh before he's even sat in the chair, because of the criticism that came from the president towards the institution. And they see him as the president's guy, which is why the criticism has ramped up so much so quickly. And they forgot to question the man who had the job only a month ago, who's been running the Federal Reserve with inflation running above target for the last 5 years. And I think people have been wary of criticising the man in the seat, Chairman Powell, because he was taking so much flack from the president in the White House. Now, I don't think it's our job to protect the institution. I think there should have been some kind of critical element to the questioning of this institution for the last 5 years that has been absent up until now. And we know why it's all of a sudden appeared pretty much everywhere, including from Fed officials themselves, in the last few weeks.
Question for you then. Do you think that the market move is politically motivated? Because since that conference, you have seen 2-year yields go higher and people price in a greater chance of a rate hike.
I don't think the move's political at all. I think the market's picking up on where the Federal Reserve is shifting to. and they're certainly shifting to an idea where they're more concerned now about the inflation side of the mandate. Now, that shift might be political inside the Federal Reserve itself, and I can't comment on that, but I don't think the market's going to be political. That's not the market's job. The market's going to price the reality of where the committee's at, and clearly the committee's shifted. Why the committee has shifted is what I'm trying to get into.
I'd like to ask Alex, has anything changed fundamentally with inflation from then to now?
Well, the oil price. And I think people they don't go back to this one unique aspect, which is oil prices have gone higher, the price of products have gone higher, so obviously the derivatives of the oil price. You've got chemical companies that are trying to pass on their pricing. So I think that has changed. So whenever people bring up the inflation narrative, I reverse it back and say, that's all well and good, but if oil went back to $70 tomorrow, then would you still have the same inflation story that you do today? And they usually say, oh, yes, because we've got 2,000 ships in Hormuz that need to get out. This is going to take 9 months to normalize. But I'm like, well, when we had an oil shock in the 1990s, early 90s, Greenspan, he made a very specific mention to look through it then. So shouldn't we be doing the same now? And people try to compare it to, say, 2021, 22. Like, this is nothing like that era. We don't have the excess saving glut. We don't have a huge fiscal tailwind. If anything, we're moving into a fiscal cliff in the second half of the year. So I think if you take the oil narrative away, and bearing in mind the tariff-based effect is rolling off too, then what are we really left with? Where's this so-called inflation? And so that's kind of where I would push back to the narrative right now.
Alex, you're going to stick with us, I'm pleased to say. Alex Altmann of Barclays sticking with us to talk about the latest in the energy market and the latest in the Middle East. Equity futures right now positive by 1/10% on the S&P, with an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. A Russian drone hit an apartment block in Romania Friday, causing a fire and injuring 2 people. EU President Ursula von der Leyen saying Moscow's war of aggression had crossed another line, while NATO condemned Russia's recklessness. SpaceX adjusted its IPO valuation target to at least $1.8 trillion from a previously estimated $2 trillion. The company is seeking to raise as much as $75 billion, which would make it the biggest IPO of all time. It's expected to start formal marketing as soon as June 4th. Treasury Secretary Scott Bessent defended the idea of putting President Donald Trump's face on a specially issued $250 bill. A 160-year-old law bans current officials or living people from appearing on American coins or banknotes. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, slow walking, the ceasefire.
There are a lot of details to work out. I think we're making progress. We're getting to a point where we could potentially sit down and settle these issues. We're not there yet, but we're very close. We're going to keep on working at it.
Bloomberg's Tyler Kendall joins us next, live from New York City this morning. Good morning. Equity futures firmer here by 0.15% on the S&P, up by 0.2 on the Nasdaq. If you turn to the bond market, declining all week yields, down every single day this week, with the exception of this morning until now. We're down almost a basis point on 10s to 444, encouraged by crude, WTI and Brent. What a move we've seen lower this week and this month, down by 10% on the week so far. Brent crude, a break of 92, WTI around 87. Under surveillance this morning, slow walking, the ceasefire.
There are a lot of details to work out. I think we're making progress. We're getting to a point where we could potentially sit down and settle these issues, but that requires us to make a little bit more progress. I can't guarantee that we're going to get there, but right now I feel pretty good about it. We're not there yet, but we're very close. We're going to keep on working at it.
So here's the latest this morning. The US and Iran agreeing to a preliminary 60-day truce extension deal. Sources telling us here at Bloomberg that President Trump has yet to sign up to the terms. Bloomberg's Tyler Kendall joins us from Washington for more. Tyler, just how close are we to actually signing this deal?
Well, John, at this point, we did hear from the U.S. Treasury Secretary Scott Bessent yesterday, who said that we perhaps have the, quote, makings of a deal. But at this point, nothing's final until their sign off, though we are getting indications and signals from both sides that perhaps they are the closest that they've been yet to this potential memorandum of understanding that would kick off essentially a phased approach towards ending the conflict. First, we would see this 60-day ceasefire extension where a reopening of the Strait of Hormuz would be prioritized. That means no tolls, no harassment, and that Iran would have 30 days to work to clear any mines in the waterway. But it comes after just yesterday, the U.S. issued a new warning to Oman, saying that any actors caught facilitating a potential payment system in the strait would come under heavy U.S. sanctions, as Iran in recent days has been trying to tighten its grip over the waterway. But it's our understanding that once the U.S. sees an easing of that grip, then the U.S. could be lifting its naval blockade in proportion to the strait being reopened. Once these components are in place, then we could see those formalized talks kick off for any potential curbs around Iran's nuclear program and what happens to that stockpile of highly enriched uranium. Perhaps some of our biggest questions at the moment, but we have to wait for that phase of talks to begin. John, in a post on X overnight, Iranian state media said nothing has been formalized quite yet, but in perhaps one sign viewed as optimism here, we did see some comments from the country's president, who did say that Iran at this point is committed towards diplomacy.
Tyler Kendall with the latest. Tyler, thank you. Down in Washington, D.C., just want to pick up on a few of Tyler's words there. Where's Israel on all of this right now?
Quiet at the moment, but the issue is that they are still going after Hezbollah in Lebanon, and for the Iranians, that is going to be a red line when it comes to negotiating, at minimum, the longer-term deal, but potentially even opening up the Strait of Hormuz.
Alex Altmann of Barclays still with us around the table. Alex, question, tech has ripped despite the Middle East or because of the Middle East?
Both. But because you've got the earnings dynamic, which is despite the Middle East. The AI spend is happening agnostic of what's happening with the oil price. Because of the Middle East, a lot of money went into the rest of the world, January, February, remember? Then as soon as March triggered, all that money flowed back into the US as a sort of a energy exporter, safe haven, and naturally it's going to migrate towards where the earnings revisions are.
Can we deal with the because now? What happens to that leg of the trade if this is addressed? Is that a risk factor for tech?
So the answer is, I think, yes, tactically. And that's really the backbone of why we're a little bit cautious. Analog here is like vaccine day. If you remember, November 2020, everyone knew it was coming. Everyone knew of there was going to be therapeutics and there was going to be a solution. But no one wanted to deploy units of risk until it was actually nailed on. So here we're hearing, oh, we're getting closer, but there's still a reticence and trepidation to deploy risk units amongst long-short managers into other parts of the market, the consumer especially, oil-sensitive parts, until that has been rubber-stamped. And I think when it does, you could see the pretty violent rotation.
Energy prices up, gasoline prices up. Why haven't energy companies ripped? John and Lisa were talking about this earlier.
That's a very good question, and I think they still have ripped. They haven't. I mean, if I'm not mistaken, the energy sector's up to 30-odd% or so. But I think it's more a function of the fact that, again, there's this anticipation of what the forward curve of oil prices are going to do. Still expectation of a resolution. Let's not forget, we could be looking at a year to 18 months from now, where UAE has bypassed a lot of their issues in terms of building new pipelines, as well as increasing their flow now they're out of OPEC. We're still producing as a country 13, 14 million barrels a day. Could we actually end up with a situation 2 years from now where we've worked around the Straits of Hormuz issue and we're dealing with another energy glut? And I think that's also equities are supposed to be long dated forwards at the end of the day. So I think some of that's at play too.
So you're not concerned if this takes 20 months the way the JCPOA took?
I'm definitely concerned. And again, I think that...
Well, no, you're offering, off-ramp.
I think the point you're making about the potential to just circumvent the whole thing's pretty interesting. I mean, how many other east-west pipelines like the one in Saudi Arabia is going to be built now over the next several years to circumvent the whole thing, to take this issue off the table?
A lot, because now structurally the region has changed and everyone realizes that Iran could just use the Strait of Hormuz as leverage, and the Iranians say that they will be charging a toll. So why not put your money to work elsewhere?
Do you think we have an inflation problem above and beyond just this very narrow conversation we're having right now, which is in energy? And Lisa's been talking about this too. Does the story go away just because the energy story does? Do we still have to focus on a potential for higher above-target inflation and higher rates too?
I think we may have to focus on it. Again, partly as a function of what's happened with tariffs, partly as a function with certain supply chain bottlenecks that are going to take a decent amount of time to resolve. This isn't just about energy. It's about the chemical sector. It's about sulfuric acid, which feeds into leaching for copper and so on and so forth. There are all other aspects which I do think matter enormously, and they will take time to resolve. And I think that's effectively where the market's adjusted to. It's sort of saying, OK, you know what? economic growth is okay. We're getting an 80 basis point tailwind from AI spend this year. We're probably going to get another 30 to 40 basis point from AI tailwind next year. So if the economic growth is okay and the inflation is still running above target, then actually we're kind of happy with rates where they are right now.
Which is why people have continued to go into even consumer cyclicals on the margins as you see this move, because they do believe that you're going to see an acceleration in tandem with an acceleration in inflation. I just wonder how concerned you are about corporate America paying these massive bills for AI. It's either going to be justified by their earnings because they're strong, or they're going to cut back because they're not getting the productivity that many people expect. How much are you watching that? The idea of people saying, all right, we're not giving you tokens because you're just making pictures on Instagram.
Well, I mean, that's definitely creeping in. I mean, I don't know about you guys, but on social media, I've noticed a distinct shift in narrative where people are beginning to look at ROIs once again, that you're hearing headlines like from certain companies scaling back their token usage just simply because they're spending exorbitant amounts of money on vibe coding and whatever it may be. And I think the reality is that, yeah, there is going to be, I think, to a degree, efficiency gains that need to happen. But I also just want to take a slightly different tack, which is we're spending, as a country, call it $1 trillion a year, just round number. It's the largest expenditure as a country, an experiment that we've done since the Louisiana Purchase, right? Now, $1 trillion being spent is effectively a redistribution of wealth. It's hyperscaler capex that's becoming revenue of other companies. So that circularity is sort of almost the illusion of earnings growth from a capex cycle, insofar that it's generating that revenue, that it's giving a boost to share prices, which is encouraging companies to spend more. And then, of course, at some point that circuit breaks. We don't know when, of course. But the point being is that now that the street has sort of come to the idea that actually $1 trillion is going to be spent both next year and probably the year after, and we're talking about 2028 bottlenecks as the reason to be bullish semiconductors still, it's 2026 last time I checked. And so on that basis alone, I think we're getting to the point where a lot of it's already now kind of being discounted.
I guess, so in other words, you're not going to see the same kind of pace of growth. I guess I wonder if we're getting to the point where we're saying, like, you know, are humans cheaper than AI? And I know that sounds really kind of crass.
No, I think people are having that conversation. I think that's fair.
I mean, I think that there's
Standard Charter.
Well, that's another conversation.
Hey, they apologized.
But to me, that's honestly the increasing question, right? Is my brain worth more than the tokens that it will cost? Well, I mean, maybe not, but
just a course of
my family might beg to differ. But you know, how much does that play into the acceleration in revenue growth, and just whether the $1 trillion is worth it?
Look, I think that there is a long, storied history of new technological capex cycles and overspending over the short term. And I don't want to be presumptuous that this is definitely going to be the case. But again, if history is any guide, there's a good chance that we're probably going to spend too much, and we'll grow our way into it over the long term. And I'll give you the analog. The analog is 2007. Oil was trading $120, $130 a barrel. We as a society had a oil molecule problem. We thought the best solution would be to go and drill through 5 kilometers of water off the coast of Brazil and another 5 kilometers of rock, and the break-even was $110 a barrel. So, and that obviously didn't work out so great. Roll forward to today, you know, we're trying to solve data center issues with potentially building way beyond our boundaries, aren't we? So I'm just wondering whether this is sort of an evidence of that overcapacity.
Shortages always end up in gluts. Booms, busts. It's the way it always goes. And then you build out from there and grow into it. Alex, appreciate it. It's good to see you. Thank you, sir. Alex Altmann there of Barclays from New York City. This is Bloomberg. The opening about 2 hours away. Equity futures up 0.1%, adding to a record-breaking rally. We're looking at 9 weeks of gains here on the S&P 500. Phenomenal. 6-day winning streak coming into Friday, looking to make it day 7 on the Nasdaq, up by 0.1%. Also, the single names we're looking at this morning, the likes of Dow and others in the pre-market, absolutely flying. More on that in just a moment. Turn to the bond market. Yields retreating. That's the good news through most of this week. Down on the week on 2s and 10s. Coming into this week, 2-year yields were up for 5 consecutive weeks. This morning pulling back on the week by around double digits, 4.01% on the 2-year, and setting the tone for the bond market, at least on the margin. Helping to drive things lower here is this move in crude. Crude down on the day, down on the week, down on the month. We're down by 2%. Brent crude at 92.
Yeah, this idea that if you do get some sort of resolution in the Middle East, you can go back to more normalized pricing. And a real question right now is how much of the inflation that we've seen, or at least inflation expectations baked into the bond market, have been driven by oil and how much has been driven by other factors due to the strength that we're seeing in some of the earnings. How tied together are these stories and how much can you pick them apart?
Cash open, 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. As you said, Dell absolutely flying. Its upside move of nearly 35% is helping to lift its peers HPE and Supermicro Computer. All this on the optimism that Dell provided. It raised its full-year outlook and said it expects AI server demand to bring in $60 billion in revenue next year. Turning to the retailers, we start with Gap. Those shares absolutely plunging down nearly 15% in the pre-market after it cut its full-year sales outlook. A setback for CEO Richard Dixon as he tries to turn around the sprawling retailer. And the notable miss came from Old Navy, and Dixon is not taking the out. He is not blaming the consumer. Instead, he says they simply did not get it right when it came to fashion. And we end on American Eagle. Those shares also plunging in the pre-market, down more than 10% after it missed on first quarter sales. And the story really here is of two brands moving in opposite directions. First, you have its core American Eagle brand that's had massive campaigns with the likes of Sydney Sweeney. Sales there fell 2%, while its Aerie brand, which makes intimates and loungewear, those sales rose 25%. So this is a massive divergence that is getting harder for investors to ignore. John.
Yahara with the update. Yahara, thank you. That stock trading lower in the pre-market. On our radar this morning, the US and Iran reaching a preliminary deal to extend the ceasefire by 60 days. Key sticking points remain, including the Strait of Hormuz and Iran's nuclear program. The president has not yet agreed to the terms. Elsewhere, SpaceX trimming the valuation target for its IPO to $1.8 trillion, down from above $2. Anthropic raising $65 billion in its latest funding round, valuing the AI company at $965 billion US, and surpassing rival OpenAI for the first time. All three of those companies mentioned in a race to IPO this year. PCE data pushing the Federal Reserve further away from an easing bias. Take a listen to this.
Right now, we're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero.
Elsewhere, the Minneapolis Fed President Neil Kashkari echoing inflation concerns, but maintaining it's too early to call for rate hikes.
I don't see the easing bias in any of the commentary. That's number one. We've been talking about that. But putting that aside, do we see a rate hiking willingness right now coming from these Fed officials? The bar is still pretty high. Every single one of them talking about how inflation is becoming more entrenched. They're concerned about where things are. At the same time, there is a scenario where the economy might require a rate increase. That's St. Louis Fed President Alberto Musalem. You also hear from Williams, President Williams, saying that monetary policy is right where we want it to be, not talking about, right, well, I mean, maybe he was the one who wanted the easing bias. So regardless of what Kevin Warsh says, this has been an incredibly dovish Fed relative to the inflationary pressures that seem to be heading for another year above that 2% target.
And certainly compared to other central banks, with the ECB well on course to hike interest rates in the next few weeks. Let's talk about the reason for this conversation in central banks right now, at least one of them. Crude. On track, at least for now, for its steepest monthly decline since 2020. Optimism building for a resumption of traffic through the Strait of Hormuz, as energy producers are highlighting the risk of an extended closure. Chevron's been warning, quote, we will start to see physical shortages. The CEO, Mike Wirth, I'm very pleased to say, joins us in the studio. Mike, it's good to see you.
Good to see you, John.
Welcome back to the programme, sir. I get this question a lot. You're the expert. Help me answer it. Why is crude at 100, at 90, and not close to the 200, given this strait's been shut for 3 months?
It's a little hard to explain. We really are seeing markets tighten, inventories draw, demand for products around the world still very strong. I think there's this belief, and we're experiencing it again the last few days, that the end is near, the conflict is nearly resolved, and flow through the Strait will resume very quickly, and that has kept the back end of the curve lower than it might otherwise have been. And I think the psychology of the market has been this is closer to the end rather than the beginning.
But what about the physical world? When will inventories be at the very bottom?
Before long. We are steadily drawing inventories down on products, on crude, in locations around the world. I think June and July are going to be critical months, and You can see the trajectory of these inventories in the data, and it's concerning.
Do you see any physical shortages right now around the world?
We do see some in some Asian markets, and we've seen some rationing. We've seen work weeks adjusted, other demand measures imposed in some of the countries in Asia. Markets are very efficient at moving products and barrels to where they're needed, and we haven't reached a crisis point yet. But the inertia in the system is very, very strong, and turning that is not easy.
One of the main sticking points the U.S. has when it comes to negotiating with Iran is this idea of the tolling. Would Chevron consider paying a toll?
No, we wouldn't.
Do you know how people are paying a toll?
I've heard reports of people using cryptocurrency in various countries. I think the Treasury has come out this week and sanctioned the new authority that has been put in place to oversee transit through the Strait. It went from a toll to a navigation fee to something else.
Would you pay a navigation fee?
A carbon tax,
I don't know enough about
will.
any of these things to say definitively. But look, freedom of navigation through international waterways is a very well-established principle. And anything like this would begin to say that countries adjacent to an international waterway can charge some sort of a transit fee. There are many other places in the world where that principle could be applied, and not just to energy products, but to all freight moving through the Straits of Malacca, the Bosphorus. Pick your choke point. And so that's not a principle, I think, that most countries in the world would find acceptable.
How far are we away from having pipelines that connect some of these countries to the mainland and their production without having to traverse the strait at all?
Well, there's a couple that exist now that you've talked about in Saudi and the UAE. The UAE sanctioned a project last year, which is about 50% complete, to get more of their production over to Fujairah and outside of the strait. So I think you'll see more of that, Lisa. The one opportunity there is, countries like Iraq and Kuwait that are deeper up in the Gulf don't have access to those pipelines. And for them, the route could be through the north and ultimately then into the Mediterranean, maybe through Turkey, where we see a pipeline comes out of the Caspian Sea over into the Mediterranean in Turkey. And so I do think one of the responses to this will be infrastructure investments that will allow these energy flows to avoid the Strait of Hormuz. And that's underway now, and I think you'll see that in the years that follow.
We started the conversation talking about why oil prices aren't higher, and you're saying that we're getting close to breaking the bottoms of some of the inventory bins. And we were speaking just a moment ago with Alex Altmann at Barclays, who said we actually could see a glut of oil in 6 to 12 months' time if there is a resolution here based on the production levels of so many different oil companies and countries. What's your take on that? Do you think that that's a feasible interpretation?
Well, history says that shortages tend to be followed by gluts. And high prices send a signal, and markets work. Consumers consume less, producers produce more in response to a price signal. And there's a time lag in the way both of those manifest themselves in the market. And what has happened historically is about the time that the new supplies reach the market, demand may have turned down through conservation measures, economic slowdown, maybe a recession, and you can see those lines cross over and the price cycles down. It's why commodity markets are cyclical, is they tend to overshoot. And, history says when we get into one of these situations, that is somewhere out in the future.
What signal do you take from the futures curve? I'd love your reaction to that, because so many people have pointed to the back end of the futures curve as a prediction of markets of where they think crude will be. How does an energy boss like yourself look at the futures curve?
Not very frequently. It's not something we use for planning purposes. We do a certain amount of hedging in our business on commercial activity where you will use futures, but we don't look at the futures curve as a prediction of future price. We do our own fundamental analysis on demand, supply, technology, policy, economic growth, and arrive at our own scenarios. And we don't use a point forecast or a curve. We use a range of scenarios. Prices are hard to predict in these markets, and so we don't anchor on a single price. We use a range of prices.
What's fascinating is you were talking about how typically commodity markets tend to overshoot and then you get the glut just as demand falls off. Are we overshooting? Because what I keep hearing is that we're not overshooting, that actually oil prices and the futures curve is remarkably low and that people keep consuming. And frankly, people like yourself are not investing in more production right now. You're not increasing production dramatically to offset some of what's going on. So is this time different in terms of the commodity cycle?
Well, first of all, we are increasing production. Our production will grow 7 to 10% this year, which is a lot in a world where demand is growing 1% on average. And so there is investment in growth. Is this time different? People say that every time and often find themselves regretting having said that. This time the circumstances here are things we haven't seen before. 20% of the world's energy production cut off for now nearly 100 days. 1 billion barrels that is not in the market that otherwise would have been in the market is not something that we've seen before. So that part of it is different. How commodity markets respond have a pattern that has been proven through different types of shocks to the system that is remarkably repeatable, maybe not perfectly predictable, but it is something that you have to bear in mind when you're in this business as you allocate capital and as you plan for your business. These patterns exist for a reason.
When you allocate capital, I wanted to ask you about Venezuela. When will you put fresh dollars into the country?
Yeah, we're currently operating under a system that's been approved by the U.S. Treasury and the Venezuelan government to recover debt that we're owed. We made some loans to their state-owned company many years ago, and they weren't repaid. And so we set up a mechanism to ensure repayment. Oil flows to the U.S., which is important for U.S. refiners. We're working our way through that, and we'll recover the debt over the next year or so, the final portion of it. And then we need a new set of fiscal terms under which we would invest in the country. Right now, the amount of tax and royalty that's paid doesn't leave enough for an investor to get a return on their investment. The country has changed its hydrocarbon law, has indicated a new range of taxes and royalties that would be applied to the energy sector, but they've not been specific about where in the range those would land. So there are negotiations underway, discussions. Even this week, we had a team in Venezuela that had some discussions on this issue. I expect over the next short period of time, we may see some clarity from them on specific values on corporate income tax, on a range of things on royalties and how that might be applied. So there's progress being made to clarify the things that would be needed in order to make those investments. But we don't have enough clarity right now. We don't understand what the regime would look like. And so it's unlikely we would put capital to work until those things are clarified.
Inquiring minds want to know, I'm getting the feedback right now. So December's trading at 84. What is the Mike Wirth Chevron price this year? What's the range in your scenario planning?
Well, the range on the low end would probably get to that number. And on the high end, if we were to see an extended constraint on transit out of the Strait of Hormuz, the question is how high is high? You get to very high numbers.
So your low is actually where December is priced right now?
Yeah, and these are all predicated on some assumptions, right? That we don't tip into a recession. We don't have some other exogenous event. Yeah, it's going to take months, John, to clear ships out of the Strait, to make sure that the mines have been cleared, to get 2,000 ships out. They don't all go out at once. You need weeks and weeks. Somebody's got to prioritize. Do bulk freighters go out first? Do container ships go out first? Do U.S. allied ships go out first or last? Iranian 2,000 ships. Who
makes that decision?
Unclear at this point.
Wouldn't it be the Fifth Fleet?
It's unclear at this point. So there needs to be a system to prioritize traffic. Ship owners have to be convinced that it's safe to transit through the Strait. There need to be some sort of security measures. And then that's just to get ships out. You have to get ships in as well. And the tanks inside the Gulf are full. That's why production is being slowed or stopped, is because there's no place to put it. The ships are full, the tanks are full. So you need new ships to come back in. Ship owners have to be comfortable sending ships back in after having ships trapped for months and crews trapped for months. they may or may not be willing to move all of their vessels back in. There's other routes now that are trading U.S. to Asia. It's a very heavily traded route. There's a lot of ships in that service. So it will take months, and then you start to clear out the inventories that are in tanks, which allows fields to restart, damage to be repaired. This doesn't happen overnight, and
Mike,
so this is going to be with us
boss.
for some time.
I've got to ask you, do you just sit here and say you first? How do you think about it?
Well, we'd like to get our ships out. It's not a decision of the ship. We have 6 ships inside the Strait right now with our cargoes. All of them are chartered, so they're owned by a third party. And we don't ultimately make the call. The ship owner decides whether or not he wants to put his vessel and his crew through the Strait. And so that's a decision we provide advice on, input to, but we can't make that decision. So it's a very complex set of decisions that need to be made to begin to get things moving again. And it will happen slowly. I would expect there'll be some stop and start to it. There still has been kinetic activity this week, some of which has been reported in the media, some of which has not. And so we see risks very real still in that
Mike, I'm a journalist. You can't say things like that.
What hasn't been reported?
What's not been reported? What are you hearing?
Well, there have been vessels that have been in transit that have suffered attacks. That
more than what we've heard of in the press.
Yes, our reports would indicate that.
What do they suggest? How frequent have those attacks been?
They're maybe not every day, but there have been multiple incidents that have occurred.
Okay. More on that in the commercial break. Mike Wirth, thank you, sir. Appreciate it. The Chevron CEO is going to stick with us. We'll have more on that in just a moment. Up next on the programme, we'll bring in some domestic issues into the conversation, playing the blame game.
As it relates to the cost of fuels, California hasn't changed anything. Those baseline costs have been static, but the cost at the pump has not been, for one reason, Donald Trump's recklessness.
Up next on the programme, we'll get some thoughts on that with the Chevron CEO, Mike Wirth from New York City. You're watching Bloomberg TV. Stocks are positive once again, up by 1/10% on the S&P 500, heading into the final trading day of a shortened trading week. Doesn't feel short, that's for sure. Nasdaq futures up by 1/10% also. In the commodity market, let's talk about crude again. WTI and Brent. Brent crude down to 92, WTI at 87.76. Under surveillance this morning, playing the blame game.
As it relates to the cost of fuels, California hasn't changed anything as it relates to that cost. Those baseline costs have been static, but the cost at the pump has not been, for one reason, Donald Trump's recklessness as it relates to the war in Iran, period, full stop.
So here's the latest this morning. The California Governor, Gavin Newsom, now blaming Chevron for the state's high gas prices. Newsom telling drivers to avoid filling their tanks at Chevron stations over the Memorial Day weekend. Mike Wirth is still with us. I imagine Mike has some thoughts on that and more. Mike, for the people of California, people waking up early this morning, perhaps on the West Coast and tuning into this programme, what's your message to them about why gas prices are so much higher in their state compared to everybody else?
Well, this is politicians gaslighting about gas prices. The fact is California's policies for 2 decades have been driving prices higher. California has 6 refineries operating today. A little bit more than a year ago, we had 9. Refining capacity is down 17% in just the last year. California has the highest taxes and fees in the nation. California imports 60% of its crude oil, 25% of its diesel, 20% of its gasoline, similar amounts of jet fuel. And we're in a situation where world energy markets are tight. And so prices are going up everywhere. California has long been the highest priced state in the country because the policies have constrained supply. And demand is continuing to be very robust in a state where supply has been consciously constrained by policy.
But how do some gasoline companies, or stations like Costco, keep actually lower prices, though?
Well, everybody's got a different business model. I think, a hypermarketer like a Costco has things they use as almost a loss leader to bring traffic in and can operate on a very small margin because you go to the big box, and that's where the revenue is, and the real P&L comes through the subscriptions and the memberships. A small service station owner doesn't have the benefit of that. They have to make a margin on the fuel that they sell and maybe some ancillary ancillary goods. So retailers all have different business models, and you see that in the marketplace, and they meet different customer needs. So you see a range of those prices.
I'm sure Chevron is going to be on the mind of Gavin Newsom as he looks for a 2028 presidential run. But it's also been, you've been front and center when it comes to this administration as well. Do you spend more time in Washington or the Permian?
Lately, probably in Washington. I like being in the Permian, but my job requires some interaction with, elected officials in the Senate and the House, the administration. And during a time of, extreme distress in energy markets, there's a lot of dialogue that goes on in Washington, D.C. So hopefully I'll get to the Permian in the second half of the year.
Yeah, which would require gasoline prices going down. And recently they've been remaining at this relatively high level, although they have dipped just a bit. You talk about how we could end up seeing shortages in the next few weeks, even in the United States. Looking right now at distillate fuel inventories, the lowest levels here since 2003, a pretty shocking number. How much could you foresee gasoline prices in the United States rising outside of California because of just simply shortages that you're seeing on the ground?
Yeah, well, right now the U.S. has come to the rescue of some of our allies around the world. We're exporting crude at record levels. We're exporting products to Europe in particular. And so what that means is products that might otherwise be used in the U.S. are being highly valued elsewhere. And so we're seeing flows in that direction. Inventories are low for diesel, for gasoline in the U.S. And we're moving into a period of time which seasonally says demand is likely to rise. The refineries in the country are running as hard as they possibly can. They're all near maximum utilization. And so the market is tight. And this is the reason why I've talked about concerns about upward pressure on prices, because you can get away from the crude forward curve and get to diesel inventories, gasoline inventories, and the prices of those products, which are really the products that are consumed. And we're in a period where inventories are tight, demand remains strong, prices are elevated, and there's risk they go higher. And shortages that have now only really appeared in Asia could begin to show up in other parts of the world.
Mike, you're one of the very best. A clinic as always. We appreciate your time. Thank you, sir. Thank you. Mike Wirth there, the Chevron CEO. As we're having this conversation, some headlines just crossing on the latest in Iran. A little bit of pushback against that MOU that's been circulating, at least the details of which have been circulating here stateside.
Right. Tasman is saying that the texts that Western media are talking about in terms of this MOU aren't accurate. And that basically means we're back to square one. But how many times have we been here when it comes for tit for tat ping pong? I think the most important thing is actually do start to see changes in the strait. Less so what people say. Are we seeing more vessels get through and less vessels, to Mike Wirth's point, not getting attacked?
The back and forth continues. Crude at the moment still lower on the session. WTI down by 1%. Brent crude down by 1.5%. Coming up next on this programme, we'll catch up with Stephen Parker of JPMorgan Private Bank, Dana Telsey of the Telsey Advisory Group on the retail earnings we've seen all week, plus Mike Darda of Roth Capital, Carey Hall of Bank of America, with equities going into the weekend at record highs.
You know the story. It's all about earnings.
Equities are priced for perfection in a world that's not that perfect.
This is a very selective market. It is a stock picker's market.
The outlook still looks pretty bright.
We are at a sort of melt up, and we could have some correction along the way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action, look like this. All-time highs coming into Friday morning. 6-day winning streak on the S&P. Hello, day 7, up by 0.15 on the S&P. On the Nasdaq, up by 0.13, just about unchanged on the small caps. The bond market's rallied all week as well. 2-year and 10-year yields are lower on the weekend on the session. We're down a basis point this morning to 4.01%. Enthusiasm in crude for the potential deal that might be struck between the US and Iran. Crude declining on the day, on the week, on the month, down a whole lot more.
The cognitive dissonance that I'm experiencing right now is very difficult for me because on one hand we see these gains in equities and a decline in crude price, and then we just spoke with Mike Wirth of Chevron, who talked about potential shortages in the United States and a real dearth of actual supply sitting in inventories that can offset some of the increase in driving demand. This is coming from an increasing number of people in the commodity space. Then in the paper space, you don't see any recognition of that. But that would change the scenario for the summer at a time where people are betting on consumer resilience, ongoing strength. If you get $5.50 on gasoline, if you get $6 a gallon, how much does that change the whole picture?
Yeah, there were my two takeaways. That was one. The Strait of Hormuz does matter, just doesn't matter yet, because we've been drawing down inventories aggressively, and at some point you get to that point. You get to that point where you hit tank bottoms, and then all of a sudden, like a reverse pandemic scenario, right, the other way around, you need prices to go so high to destroy demand. How high? Don't know. Let's hope we never get to that point. My second takeaway from that conversation was on the futures curve. So you pick out a point in the futures curve and you say to him, okay, this is where December's at, 84, 85. Where do you see things? Where December's trading is the best case for Mike Wirth Chevron in terms of just how low crude might go. So the best case for you at home.
Yes,
that's where he thinks it will be for the consumer. That's his low for the year, which is the base case for a lot of people in this market.
Also, he says he doesn't look at the curve, but if he did, that's where his is lining up for the best case for the consumer. You know, it was interesting, though. He wouldn't give you what the worst case for the consumer is or the best case if you're an energy executive. But it sounded like it was something along the lines of what Jeff Carey has been telling us. Maybe upwards of $200, $250. And why it is so interesting now, and it makes sense, that you see the administration potentially willing to have an MOU, which means there is going to be concessions on the table, even if they're not telling you, is because Mike Wirth says June and July are, quote, critical when it comes to the physical market.
And who goes first when you start to get the ships out?
That's interesting.
I thought it was a really interesting conversation too. How quickly do the ships come out? Who goes first? And then you need to send the ships in to get things out. I know that markets, anticipatory asset classes like equities, will look through a lot of that. I understand that's what stocks have been doing now for the last several months. But in the energy market, the physical world, that's tough.
I love how paper markets try to gloss over all of this. But even when you study war, it always comes down to logistics and understanding the logistics and executing all of those little details. What about the psychology of different navigators of these ships that have been going through, getting shot at, having to go back? How do you get them, entice them that they're not going to be putting their lives at danger to go through?
It's going to cost a lot of money.
A lot of money. Brent crude this morning, 92. We're down by 1.7%. Coming up this hour, we'll catch up with Stephen Parker of JPMorgan Private Bank, with stocks building on record highs. Mike Darda of Roth Capital on why the US economy is holding up better than the data suggests. And Jill Carey Hall of Bank of America as Dell caps off a banner week of tech earnings. We begin this hour with stocks riding momentum from the tech trade, keeping the S&P on track for a 9th consecutive week of gains. Stephen Parker of JPMorgan Private Bank writing, we're upgrading our earnings and price targets. Our 27 mid-year target for the S&P is now 8,200. There is a potential bull case scenario that gets us closer to 9K. Stephen joins us now for more. Stephen, good morning.
Morning.
Let's start with a change. What underpins it? You're not allowed to say earnings. Okay, earnings. Go on, tell us.
It's all earnings. It's really simple. We came into Q1, markets were expecting something like 12 or 13%. We got 30. You know, we're looking at 20% earnings growth for the year and another 10 to 15% earnings growth for next year. So you don't need to make any sort of heroic assumptions about multiples if you can get that kind of earnings growth.
The Strait of Hormuz has been shut for 3 months. Stocks over that period, the S&P up 10%, Nasdaq up 20%, semis are up by more than 50%. What have multiples done over that period?
Multiples have come down.
That's just crazy to think about, isn't it?
That's the thing. And tech, which is what people have been most focused on, most concerned about, has seen the biggest decline in multiples because the earnings are just blowing it out of the water. And the rally that we're seeing isn't able to keep up with the fundamentals.
How much does that change if consumer oil prices skyrocket in the next couple of weeks?
Well, I think the thing we have to remember is that the market, particularly the U.S. large cap market, today feels more different from the economy than it has at any point in my career. So we spent a lot of time focused on the impact of higher energy prices on the consumer. The consumer is a much smaller part of the actual S&P. What's driving S&P? It's really the AI story, so it's the technology CapEx story, and then it's the broader infrastructure story. The good news is that earnings growth, tech is a big part of it, but we're also seeing it in other sectors like industrials, like utilities. it's not just a consumer story.
This is a very confusing market when you try to overlay traditional economics on top of it, because typically if you start to see oil prices get to a certain level, that would trigger some sort of backlash, some sort of reduction in consumer demand. But right now you have an inelastic spender in the form of AI, and it has to do with the energy market. It has to do with commodities. So you could see inflation being stickier even without the participation of consumers. How much does that raise the specter of a hawkish Fed in response to something that could be potentially a shock to the consumer, but still leads to higher inflation in the economy?
Yeah. So first, let's remember, when we think about the things that drive earnings and drive revenues, it's not real GDP growth, and we've lowered our real GDP growth. But the inflation piece of it means that nominal GDP growth is still growing at a very healthy percent. So the broader economy, and you're seeing that pass through. As it relates to the Fed, we actually think that Q2 is likely going to be the peak in economic growth and the peak in inflation for the year. And so we think that we're going to see a slowdown in the back half. We think we're going to see inflation begin to normalize, not back to the 2% level, but lower than where it is today. In that case, our base case view is that the Fed is likely on hold. We've seen a huge shift in expectations. We never believed that the 2 or 3 cuts that we were expecting at the beginning of the year. We don't believe we're going to see the hikes that markets are now pricing. The Fed's going to be on a wait-and-see mode.
On hold until when? And then you think the next move is then what? A cut?
We think that they're on hold through the middle of next year, and then it's going to be data dependent. If inflation does remain stickier, if we get some sort of shock, then they're in a tricky position. If oil spikes too much, and we looked at this through the lens of 3 different scenarios, if we get an oil price shock to $140 a barrel, the immediate instinct is going to say, well, maybe the Fed is going to have to hike because of inflation issues. We think at that level, the risks of recession start to grow to a point when you may actually be looking at a cut. It's really this $100 to $120 level that puts the Fed in the trickiest situation.
The Fed's on hold, but given everything around them's changing, is policy getting easier?
Well, we are seeing signs that policy is getting easier, whether it's, we're seeing credit spreads are behaving very well. We're seeing that, lending is, continuing to grow. The rally in equity markets means that, financial conditions are easing. And so, yes, in fact, what we've seen over the last couple of months is even with the Fed on hold, financial conditions broadly are providing more support than perhaps people are noticing at the headline level.
Just listening to that argument, that's an argument to buy stocks. Yeah. Inflation above target, Fed's not hiking, buy stocks. Financial conditions are loose. These hyperscalers are issuing debt, raising money to put that money into the AI ecosystem that is driving the chips trade, buy stocks. What would upset the trade?
So I think the biggest risk that you're looking at from an equity market perspective is some sign that the AI-related CapEx boom is going to slow down, right? That's underpinning a lot of these trades, whether it's semis, whether it's memory, whether it's the infrastructure build out. That's the thing that all of these assumptions, that 20% growth is based on a continuation of this capital spending. If we were to see signs that we were looking at a pullback in that spending, that to me is the biggest risk to the equity market.
How do you gauge whether it's worth it, the cost of some of these AI tools? I mean, increasingly that's the question, right? You have to see the return on investment, and if you don't, why do all these companies keep spending so much going forward?
So I think it's going to take some time, perhaps a couple of years, to get a definitive answer on that. But one of the things that we watch closely, we actually look at a basket of companies that have indicated in their earnings announcements that they are leaning in on AI, not just as a productivity enhancer, but as a growth driver. And if you look at the profit margins on the broad index over the last couple of years, margins have expanded. It's gone from 13% to 15%. If you look at the basket of these companies, those margins have gone from 13% to 17%. So there are signs that this AI payoff is actually taking hold, not just in the tech sector, but across a number of industries broadly, financials, industrials, healthcare. And that's why I think these companies are going to continue to be willing to spend.
Do you think we're seeing substitution yet for the technology and real labour? Are we seeing that? Do you think they are looking at this technology now and saying, you know what, I think it's good enough to replace someone, I'm letting someone go? Or do they look at this technology right now and say, it's getting really expensive, I need to let someone go to carry on paying for it?
I think that there are pockets where you're seeing replacement, but I think that's the low-hanging fruit for companies, and I don't think that ultimately those are going to be the winners of this AI trade. The companies that are ultimately going to be the biggest beneficiaries are the ones that use this technology not to replace labor, but to enhance it, to upskill labor. And that's what we're focusing on. We're not hiring any less analysts or summer interns. We're just having them come in with tools that are going to make them better, faster, more productive at what they do, and able to spend less time formatting charts and more time researching investment opportunities.
Is that a sector story then, the financials, or do you see that at individual names within a sector? What's the argument now from an equities perspective?
One, I think it's going to be across every sector. I don't think there's any part of the equity market where AI is not going to be an important differentiator.
I think it lifts all boats.
Well, no, it's not going to lift all boats. I think it's going to lift the boats of the companies that really commit and spend on AI. I think what you're going to see is greater differentiation between companies within sectors and across the market. You know, companies that use AI to focus on simply replacing labor, I think that's a short-term sugar high. I think that the companies that focus on AI as a productivity tool to drive growth are going to be the ultimate winners. That creates a really interesting opportunity for active managers.
So if I hear someone say they want to replace low-value human capital, that's not a buy?
I won't comment on that.
Okay,
But that's certainly not what we're doing.
You avoid. Stephen, it's good to see you. Thank you, sir. Thank you very much. Stephen Parker there of JPMorgan Private Bank. On the spot, forgive me, but a lot of people will be thinking about that question going forward.
There are going to be losers, though. And what's interesting is it's not going to be at companies or individuals necessarily, but they're going to be companies that gain market share so much so that some of the other companies fall out of business. So it's going to be bigger companies that have a bigger glut of business that kind of knocks some of the others out of the running.
The more constructive way of thinking about things. We saw this from David Solomon in his essay in the New York Times, well-written piece. If you haven't read it, go over and read it. Also heard it from the BNY CEO, Robin Vince, on this programme just yesterday. Capacity builder. It gives them extra capacity to do more. That's the constructive view that I hope is the way this goes forward. I hope it's not the more depressing view that came from Citrini Research a couple of months back.
If you go with that view, you think about a Walmart or a Costco that's able to monetize the data that they have, implement some of these tools, well, then that's going to destroy a lot of the mom and pops, which already has been happening, right? In the financial sector, what does that mean for smaller banks, for ones that can't adapt to this change? Or is the market just going to expand that much more? These are the questions that people are increasingly asking.
Stephen, good to see you. Thank you, buddy. Thank you very much. Futures positive by 1/10% on the S&P with an update on stories worldwide. With your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. Iranian state media claiming the text of the preliminary deal between the U.S. and Iran is being incorrectly reported by Western media. Sources told us here at Bloomberg that the two sides reached a tentative deal extending the ceasefire by 60 days and to launch nuclear talks. Meanwhile, Anthropic raising a fresh $65 billion in its latest funding round. The funding was led by several firms, including Google and Amazon, who each contributed several $1 billion. The influx lifting Anthropic past its rival OpenAI's valuation for the first time. And in sports, the NBA Western Conference Finals is heading for a decisive Game 7. The San Antonio Spurs dominating the Oklahoma City Thunder in front of the home fans. Victor Wembanyama led all scorers with 28 points. Game 7 tips off Saturday night with the winner set to face the New York Knicks in the finals. That's your Bloomberg brief. John?
Dude is a monster, total beast. Yahira, thank you. Appreciate it. Isn't that the best news for you and the Knicks? Game 7.
Yes, because we want them to exhaust themselves.
Right.
But overnight, there was reports that Mitchell Robinson, Knicks player, fan favorite, broke his pinky. I hope it's going to be okay, or just you're going to have to tape it up, dude. You're going to have to play with a broken pinky.
That's the message coming from Annmarie.
It's NBA Finals. Suck it up.
It's a broken finger.
It's a pinky.
Okay, but still, he's a basketball player and it's a broken finger. All right.
It's all right.
Suck it up, apparently. Annmarie, not me.
Happy Friday.
Futures positive by 1/10%. Up next on the programme, the Morning Calls Plus, Danny Telsey of the Telsey Advisory Group as the retailers paint a mixed picture on the US consumer. That conversation up next.
June and July are going to be critical months, and you can see the trajectory of these inventories in the data, and it's concerning. One of the responses to this will be infrastructure investments that will allow these energy flows to avoid the Strait of Hormuz. Shortages tend to be followed by gluts. About the time that the new supplies reach the market, demand may have turned down and the price cycles down.
Such a brilliant exchange with the Chevron CEO, Mike Wirth, about the difficulties in the energy sector right now and the complexities when it comes to getting energy moving again through the Strait of Hormuz. And it goes beyond a deal between the US and Iran. Once that happens, then you've got these logistical questions you need to address. Getting ships moving again. Who goes first? Getting ships back in before they get back out. And also, he gave a nod to maybe this idea that things are tense, more tense than we were led to believe this week. Ships finding it very, very difficult to get in and out the Strait of Hormuz.
Yeah, basically that more skirmishes potentially or clashes were happening that have gone unreported. Also, if a deal is struck before even whoever decides, he said he didn't know. I thought maybe it'd be the Fifth Fleet. He didn't know who actually decides who goes first to these, whatever, 2,000 ships that are stuck. You have to make sure that there are no mines left. Because as of a few days ago, CENTCOM was saying the Iranians were trying to lay mines once again.
So that's the situation in the Middle East. Now let's bring it home and talk about domestically in the United States. We've talked about this a number of times on the programme. We've been cushioned by the amount of inventories we've had worldwide, but particularly stateside, that we've been eating into to supply this market, to cushion the market, if you will, and stop prices from going to infinity and beyond. He thinks we're getting pretty close. I'm not going to put a date on it. He wouldn't put a date on it, but getting pretty close to testing tank bottoms. And when that happens, we've got a big issue.
Just to give you an example, U.S. distillate fuel inventories have dropped to the lowest level in the United States since 2003. It has been absolutely falling off a cliff. You see a similar dynamic in gasoline. The U.S. has been exporting a lot to the rest of the world because prices have been higher there. As this goes on, do they redivert some of the supplies back to the United States with oil prices going higher? Or globally, do you just see this race to try to obtain gas, leading prices to go to the moon? I mean, what is the limit to potentially the upside in prices?
92 on Brent this morning, WTI around 87. Equity futures doing OK, positive by 0.1% on the S&P, a record on the S&P 500, a record on the Nasdaq. That's up as well by 0.1%. Let's talk about one single name. Your morning calls, one stock in focus, it's Dow. First up, Barclays more than tripling its price target to 550, keeping an overweight rating on the shares following its massive earnings beat. Elsewhere, Wells Fargo hiking its price target to 505, saying the inflection in traditional non-AI server demand was a standout. And finally, JPMorgan lifting its price target to 500, highlighting the demand environment tracking well above expectations, saying Dow's underlying strength remains evident across multiple drivers. That stock is up 35%, and analysts are struggling to keep up. Elsewhere, a busy week of retail earnings giving a mixed read on the US consumer. Dana Telsey of the Telsey Advisory Group lifting her price target on Best Buy, trimming her target on American Eagle, writing current data points are demonstrating resiliency even in the midst of macro volatility. Dana joins us now for more. Dana, good morning.
Thank you. Good morning. Thank you for having me.
We were talking about the gap. How refreshing it is to have a CEO just come out and say, you know what, I'm not going to blame the consumer, not going to blame the environment. We missed it. Why did they miss it?
They missed it in Old Navy. They missed it in dresses, whether some of the seasonal dresses. But the interesting data point is they're beginning to see some signs of improvement. They did well in Old Navy, in men's, and also in women's tops. And you have to say the Gap brand, a 10% comp in the Gap brand. We haven't seen a 10% comp in the Gap brand in a long time. And they raised their earnings for the year, their guidance, some of it due to a lower tax rate, but also the confidence they have in the other brands. It is the Old Navy brand. Athleta is small, but that's in focus in order to show some signs of improvement.
As an analyst, how do you price mistakes in fashion like this? Because it wasn't just the Gap. It was also what we saw from Abercrombie and Fitch with a couple of missteps. Evidently, jeans or pants or whatever didn't sell as well as people expected. How do you game that out for long-term multiples?
I think overall, when you look at the companies, and companies aren't stocks and stocks aren't companies. Companies are going to have misses in fashion sometime, but as long as they can reverse themselves and you're seeing the other components of the business grow, because it's always an equation and algorithm. Sales growth, less expenses, hopefully expenses don't grow as much, give you earnings growth. When you think of the drivers of Gap right now, and you see the fact that the Gap brand's accelerating, they're investing in marketing, they're going to be net store openers now from being flat and closers over the years. You look at the new loyalty program, look at the innovation they have with Zach Posen and product with collaborations. They have become part of that cultural conversation and are relevant again. So I think opportunities like this, and obviously you don't want misses, but it is an opportunity because I think they get back in the saddle and we see the biggest business progressing, and it's a low multiple right now. And you think about the consumer and just the consumer sector, they've been a bit resilient. We're going through this first quarter earnings season as definitely gasoline prices have gone up. We know about the stickiness of headwinds. Look at what you just talked about with the conflicts in the Middle East. Yet, A 17% comp at Roth stores, a 17% comp at Ralph Lauren. You just talked about Best Buy also. And I see more green shoots than not when the consumer sector in stocks haven't participated. Overall, the XRT retail index is flat. You look at the Dow and the S&P, they're up mid-single digits to low double digits. So valuation matters in the consumer sector.
Are you seeing any increase in margins, ability to raise prices or cater to the higher-end consumer to pad out some of the earnings?
We've seen that. I was with Tapestry earlier this week. You look at the Coach brand. Yes, they've had ability to raise margins. You're seeing that from others also. And what you don't know is who knows when companies are going to get tariff refunds, but that back half of the year, that could come into play and be a benefit.
Interesting you mentioned Tapestry. Any chance we see a tie-up with Capri under this administration?
No. I think basically Tapestry is focused on the Coach brand, executing and amplifying the growth that they have, capturing new customers, and they're focused on reinstating growth and getting to stabilization for Kate Spade.
Coach is doing really well. But it reminds me of the Coach of like the early 2000s. But it's selling off the shelves. What are they tapping into?
I think overall, the data insights that they glean about their consumer and what they like. I'll give you an example. They basically survey what Gen Z customers are spending time on. They like reading books. They did a campaign all about storytelling in books. What did it do? They added new items to whether it's the Brooklyn collection, whether it's the Tabby collection, and it comes into play. You look at their stores. They've now added these Coach coffee shops to some of their stores. Destinations where consumers spend time with relevancy of product provides an experience that works.
What did you think of Ferrari torching its brand earlier this week?
Oh, that's interesting.
Any feedback on that?
No, I haven't heard any feedback there.
OK, all right. Dana, good to see you.
Good to see you too. Thank you.
Dana Telsey there of the Telsey Advisory Group. Coming up a little bit later, don't miss this, 10:15 Eastern Time, the Gap CEO, Richard Dixon, catching up with Bloomberg's Lisa Abramowicz, our very own Bramo. Later on this morning.
Well, key to me is, first of all, he didn't blame the consumer, as you were talking about, which is really notable.
It's encouraged.
It's encouraged. Yeah, I think that's an honest look at what went wrong, and then how's he going to fix it, right? What actually happened at Old Navy, as Dana Telsey was noting, with respect to the dresses? How do they get a better gauge on that? I also am curious how he's deploying some of these AI tools and how he gauges whether the cost is whether the juice is worth the squeeze, given the conversation that we keep having.
They have some cool World Cup merch at Gap and at Old Navy.
Haven't seen that.
And you know what? Maybe next quarter will be good.
I'll check it out. The first Luce merchant of this morning. Squeeze that in.
Yeah, you gotta. It's Friday. We have to mention it every single day this week.
Didn't buy.
Well, yeah, Chevron might have. I actually was curious if Mike Wirth had bought a Luce.
That would have been a good.
Definitely not. Mike Wirth is not rolling around a Luce.
I think that he would have enjoyed it.
Mike Darda of Roth Capital. He joins us next. Equity futures firmer here by 0.1%, 60 minutes out from the opening bell. What a run we've been on. 9 weeks of gains almost, going into the weekend. Quite a stellar weekly run of gains on the S&P 500. On the NASDAQ, positive by 0.1%. In the bond market, 2s, 10s and 30s. Yields look like this morning. 2s just about unchanged at 4.01%. 10s at around 4.44. Just some pressure coming out of the bond market. Bit of a rally building through the week. This has helped, that's for sure. This move in crude, WTI and Brent. Brent crude this morning down to 92. WTI at about 87. As we count you down to the cash open, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Dell's massive upside move of more than 30% in the pre-market is helping to lift its peers, with Supermicro Computers and HPE also rising in the pre-market. All this tied to the optimism that Dell provided, the company raising its full-year outlook and saying that AI server demand will help bring in $60 billion in revenue next year. Turning to the cybersecurity firm SentinelOne, those shares are plunging nearly 15% in the pre-market after it delivered a disappointing outlook and announced plans to cut roughly 8% of its workforce. And while analysts note that demand is not collapsing, what they're questioning is why this company isn't capturing more of the spending boom in cybersecurity. And we end on the retailers. They are getting punished in the pre-market. Both Gap and American Eagle disappointing when it came to sales. Gap says the issue was not the consumer, it was execution. CEO Richard Dixon acknowledging the company missed the mark on key seasonal fashion. At American Eagle, the divergence continues between its core brand and its brand Aerie, and that is causing shares to plunge 12%. John?
Yeah, Hara, thank you. I imagine investors aren't going to be happy. I understand why no one wants to see a stock you hold down that much, but refreshing that we're not blaming the weather, the consumer, the price of energy, the FX market, just saying, you know what, we've got a product, we've got to execute, and we did it.
And it highlights how strong the actually underlying economy really is. As far as execution going forward, how do you get it right? And how much are investors potentially patient, given that fashion tends to be fickle? I mean, what do? Check on the memes?
Exactly. The look didn't hit, and that's the problem. But it is fickle, and if you have a less discretionary income, you're going to be, I know you hate this word, but you really are going to be choiceful in where you decide to spend that money.
Choiceful.
You are.
Choiceful. Selective.
Okay. Why not go to a richer?
Choiceful just sounds like you've got more choices. Do you know what I mean? But you don't, because you've got less money. So I just don't like the word choiceful for that reason.
Selective is good.
Right? Because the retailers will say that consumers are choiceful. Well, they're not. They've just got fewer choices. So why have they got choiceful?
It's your glass half empty.
Right?
You've got fewer choices. You're not full of choices.
Thank you, Brahma. What is hitting right now? What is the look? I wear the same thing all year. What is the hook?
Well, because
I wear this to bed.
You wear a suit and tie.
What's the
Actually,
hit?
it's interesting. I find that more and more people are finding similar looks, what they would call dupes of more expensive brands. I'm not talking about Gap exactly. Dupes okay. On things like Amazon.
On Amazon? People are shopping on Amazon for clothes now?
Yes.
That look like the real deal?
Yes.
Okay, got it. You doing the same thing?
You're asking me about
wear
fashion
the same
advice.
Thing all year.
I honestly, if I just would have a uniform, that would work for me.
Almost like Zuckerberg, just with like a wardrobe with just, you know.
I wish women could get away with that. Honestly, I would wish I could do that.
All year
100%
round.
Black t-shirt and jeans.
Let's talk about the bond market. Treasury yields elevated as investors weigh cautious commentary from Fed officials. Joining us now to discuss, Ira Jersey of Bloomberg Intelligence. Ira, the good news this week, at least, is yields have fallen back. Good news, of course, if you're looking for yields to fall back on 2s and on 10s. Ira, I just want to start with the commentary from Fed officials. We've had some pushback to the easing bias, but from what I hear from the likes of Neil Kashkari of the Minneapolis Fed, I get the sense, Ira, the bar is still pretty high for a rate hike. How high is that bar?
Yeah, I think it is pretty high. For one thing, they really want to see more sustained inflationary pressures and not the lack of spending. You guys have been talking a lot about spending and the consumer in the last few minutes, and one of the things that I think worries a lot of the Fed officials is, will we see a slowing in the real economy excluding energy? Because that does tend to slow real growth. So they're worried that, hey, if we hike interest rates now, we might be the cause of a recession, and that's the last thing that we want to do at the moment.
Ira, what do you think the biggest risk is right now? A hawkish mistake or a dovish one?
Yeah, I think it's a hawkish mistake, actually. And I know there's a lot of people who disagree with me. We've been at, a little bit above the 2% target for quite a long time. But I think the risk is just from the macroeconomic sense is that if they were to hike interest rates now, you get the short end of the yield curve up, probably the curve bear flatten in that situation. And if that were to occur, you'd wind up in this awkward situation where you'd actually enhance some spending, right? Some AI spending, for example, that is debt financed, because the 10-year yield might not move very much at all. But short-term interest rates wind up going up. So you end up slowing the consumer more. You have less short-term debt that's going to be used to enhance the economy. So things like auto loans and the like would wind up being more costly, and that would just hurt the consumer even more.
That said, Ira, does it make any sense for them to maintain an easing bias based on what we're hearing from a lot of CEOs, including retailers? I mean, even Gap and American Eagle saying any miss was simply because of fashion misses, not because of a consumer that seems to be struggling in any way.
Well, I agree that they probably aren't going to be cutting anytime soon. And, that easing bias, that basically one phrase in the statement that people claim was the easing bias, you had to squint to see the easing bias. So I really think that, they're at neutral territory, by some measures. And, yesterday, Stephanie Rule, excuse me, not Stephanie Rule, Bloomberg Television had a Fed president on down. And, he mentioned, hey, 1% is our star target, right, our neutral rate, and we're basically a little bit under that. So that's the reason why I think people think, hey, they might hike interest rates. But I think from the Fed's perspective, they're like, okay, look, if energy prices come back down and you wind up with oil back at $80 a barrel, we're probably still looking at 2.5 to 3%, 3% inflation. 100 basis points over that is right where we are now. So that's why they think we're pretty close to probably neutral in the medium term, not necessarily in the long term.
Shout out, Steph. That's a throwback, Ira. 10 years ago.
Yeah. I worked with her too, so.
So did I. Good times. Ira, thank you, sir. Appreciate it. Ira Jersey there of Bloomberg. Mike Darda of Roth Capital writing the following. High-frequency data remains robust. We're not seeing meaningful softening in overall macro momentum. Mike joins us now for more. Mike, I'll repeat the question that I asked Ira just moments ago. The biggest risk here, a dovish mistake or a hawkish one?
Thanks for having me on, Jonathan. Look, I think the Fed is really well positioned here. Let's keep in mind they've dropped policy rates almost 200 basis points. And so they've already done a considerable amount of easing, considering that the business cycle has not fallen apart on us. So, if they're neutral, pretty close to neutral, maybe slightly below neutral, just stay neutral, right, as we move through these shocks. So, I'm not really answering your question because I think they're in a pretty good posture. So just keep it up, more of the same.
So you agree with John Williams of the New York Fed that you think policy right now, Mike's at a good place?
I think it's in a good place. And, certainly you could argue that, perhaps the Fed is maybe just a little bit below neutral. That's a shock absorber for the economy as these uncertainties hit us. Last year, we dealt with a big tariff shock. Obviously, geopolitical and energy has been the story this year. And through it all, we've maintained essentially full employment, and the flow of macro data has been quite impressive. And I think that speaks to the fact that the Fed has not clobbered the economy with a contractionary monetary policy on top of a supply shock. If we go back to some old research that former Fed Chair Ben Bernanke did back in 1997, he and a team looked at the 1970s oil shocks, the 1990 recession, and came to the conclusion that it was actually contractionary monetary policy that did most of the heavy lifting in terms of economic disturbances, not the oil shocks themselves. And so we're living proof in this cycle so far that the Fed's basically getting it right.
That said, Mike, a real question about how much inflation really is just being driven by the oil shock that we're seeing versus broader-based pressures as consumers keep spending, as you do see their savings still, yes, getting depleted, but still available, and you see these incredible earnings from companies.
Absolutely. I mean, look, the equity market has been super optimistic. Earnings have been quite strong. Markets aren't always right, but they do look forward. If we come through this, and I think we're coming through it, there is some risk of a broader-based economic acceleration, and that would likely cause markets to price in potentially a more meaningful probability that the next move is a tightening or a rate hike by the Fed. I don't think that's coming anytime soon. But if we were in an environment later this year where the labor market's actually tightening with the unemployment rate dropping, I think, incoming Fed Chair Kevin Warshton has his work cut out for him because I think you'd see a lot more hawkish voices on the Fed in that scenario.
A number of economists have also talked about the idea that the neutral rate is significantly higher than what people initially thought, that it wasn't necessarily 3%, but it could even be closer to 4 or even above that based on just the growth that we're seeing despite where rates are. Do you agree with that? Do you think we need to reassess the potential in this economy?
Well, I think we know for sure it's higher than it was in the last cycle because the economy has performed quite well with much higher rates. So that kind of tells you what you need to know. We can't measure the neutral rate in real time, unfortunately, but we can look at how the economy is performing. And as we go through these supply side disturbances, tariffs last year, energy this year, the key is, how are these nominal aggregates holding up? Nominal income, nominal spending. Supply shocks mostly impact the real side. They drive it down and inflation gets driven up. So the nominal aggregates, aren't really reflective all in except for, the impact that monetary policy is imparting. And they've been quite steady, 4.5% to 5.5% in terms of nominal spending. and that gets reoriented to more inflation and less real growth with a supply shock, but the central bank can't do anything about that. So this tells me, Fed probably pretty close to neutral here. Unlike the situation in 2022 when we had, a supply shock in energy markets, nominal aggregates were growing at a double-digit pace. So the Fed was offsides then and needed to tighten policy. And that is not the case today, and that's good news, and the markets are celebrating that.
Michael, what if we see the worst case scenario that the Chevron CEO talked about, which is at the end of the year, you're looking at prices much higher than the curve is pricing in, maybe closer to $200, $250 even. He didn't say those words, but that's what we were gleaning into. What does the Fed do then? Because you can't hike for lower oil prices.
Yeah, I think in that kind of a scenario, then, we would have much more downward force exerted on real incomes, on the real economy, and more upward pressure on inflation. So that is a more severe supply side shock. The economic literature says that the central banks should really try to look through that, not respond to it with a drastic tightening of policy, which would just have a hugely compounding effect on the real economy. So, that's not a situation that anyone wants to see. It's certainly the worst case scenario for the central bank because they're having to explain away, even higher inflation after having missed the target for 5 years. And you've got the economy weakening. So hopefully we avoid that. But in that kind of a scenario, you would really want the central bank to be looking through that kind of a disturbance if it's on the supply side. Central banks can do demand, but they don't control the supply side of the economy. They don't control energy scarcity, and they don't, control trend productivity. So they would have to do the look-through, see-through approach that, so far has served them quite well. That's what they did with the tariffs, and that's what they've done so far.
Has it served them well, though, Mike? And I guess this is the struggle I've got, so help a brother out. I'm struggling to internalise this. How is monetary policy both in a good place, but inflation's been above target for 5 years? How do you square that?
Well, Jonathan, I think we talked about this last time. I mean, the Fed did make an inflationary goof in a major one in 2021 and 2022. So that was the initial catalyst for inflation going way over target. The nominal aggregates exploded like you didn't see since the 1970s. They've largely corrected that, but we have a tariff shock and an energy shock recently that have, largely contributed to the inflationary overshoot. The Federal Reserve Board did some very good research at the end of last year showing the tariff shock probably was responsible for the full overshoot in PCE inflation before we went into the energy shock this year. And now, obviously, we have another shock underway. So let's give them at least partial credit for doing it right over the course of the last few years. But you are right, that they did have a policy mistake, and a major one, along with, excessively easy fiscal policy earlier in the expansion.
Mike, it's good to see you. It always is. It's great to hear from you, buddy. Mike Darda there of Roth Capital on the latest. Equities on the S&P, just about positive. The Nasdaq flipping negative briefly just moments ago. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Dell shares rising 33% in the pre-market after it issued a revenue outlook that far exceeded expectations. The company now expects a massive $60 billion in AI server revenue next year, while demand for traditional servers also helped drive results. SpaceX adjusted its IPO valuation target to at least $1.8 trillion from a previously estimated $2 trillion. The company is seeking to raise as much as $75 billion, which would make it the biggest IPO of all time. It's expected to start formal marketing of its IPO as soon as next week. And the third round of the French Open is underway in Paris, and the tournament has already produced a major surprise. World number one Jannik Sinner lost in 5 sets. He was just 1 game away from victory in the third set before his opponent mounted a comeback, winning the next 3 sets to send the top seed crashing out. Apparently, it's hot in Paris. That's your Bloomberg Brief. John?
Yahira, thank you. Suffering from serious heat in Paris. Jannik Sinner was cruising to a win and then absolutely collapsed.
We've talked about this before, the physical prowess of some of these individuals to be able to play that hard for that long in that kind of weather. Props for trying. I wouldn't even try.
I was surprised he carried on playing.
Exactly.
To be honest with you. Up next on the programme, we'll set you up for the day ahead and the week ahead. Plus, we'll catch up with Jill Carey-Hall of Bank of America on how AI is benefiting small caps. That conversation up next.
as the market's going up, volatility is rising with it, and that's sort of indicative of a chase and reach for upside. We're effectively advocating, say, like, you've got a lot of gains, hopefully, and it's actually a good opportunity. You should be hedging when you can, not when you have to.
That was a more cautious Alex Altmann of Barclays there, much more cautious over the past few weeks on this equity market. Equity markets look like this right now, positive going into the cash open, up by 1/10% on the S&P, just about unchanged at the moment on the Nasdaq. On the Russell, down by 0.2%. For the week ahead, things are stacking up as follows. We get some data on a Monday, PMI and ISM manufacturing data. Tuesday, the JOLTS report. Wednesday, some earnings. Look out for Broadcom, CrowdStrike. Plus, we get more data, ISM services data. Thursday, jobless claims. Lulu in focus on Thursday too. Lulu has been awful this year. That stock is one of the biggest losers on the year so far on the S&P 500. Friday, the payrolls report. So for the Federal Reserve, you've got payrolls next Friday. The following Wednesday, you've got CPI. Then the following Wednesday is the FOMC decision.
How do they balance this other than just removing an easing bias? A lot of it will be determined by wage growth, and not just wage growth, but how much we see ongoing gains in the labor market. To me, Friday's going to be a big deal.
Does any of it matter if you went down? The stock is up by 35% this morning, absolutely skyrocketing. Demand for AI servers showing no signs of slowing down at all. It's not just large caps. Jill Carey Hall of Bank of America writing this. AI beneficiaries aren't just in large caps. You're also seeing this in small and mid-cap mentions of AI are skyrocketing. Jill joins us now for more. Jill, welcome to the programme. We've seen this build. Just last week, I noticed that small caps outperformed, equal weight outperformed. Jill, is it still just the one trade? It's still about tech and AI?
I think some of it's been about tech and AI, because if you look at, the top contributors to the Russell 2000 performance this year, a lot of them have been some of the AI infrastructure stocks. But certainly you've seen, energy and commodity-oriented sectors outperform. But I think, there's still, even though small caps are up, 18+% this year, they're still not up as much as earnings are expected to be up. And there's still some sectors that have lagged, financials, healthcare, some areas that have looked good in our work. So I still think that there's upside for pockets of small caps this year.
Are there particular industries that you see benefiting disproportionately from either AI efficiency gains or other dynamics that stand out aside from the whole index?
I mean, I think healthcare overall, both in large and small caps, is one that will benefit, has a lot of use cases from AI. Our analysts have written about this. I think small caps overall will benefit on the efficiency side just because they're a lot more labor intensive than large caps. So they have, higher ratios of employees relative to sales within small caps. So I think sectors like financials, can still see not only from AI, just, productivity improvements, automation, potentially even, deregulation, taking costs out. So I think it's something, even industrials, is a generally labor intensive sector. So I think there are a lot of areas, AI, automation, efficiency gains that can help.
Does this thesis hold ground if oil prices surge once more in the face of, say, a deal that doesn't come together, or even just a restart of some of the conflict?
Right. I mean, I think, higher oil prices so far have been beneficial to earnings overall and to small caps. Small caps have more exposure to areas like energy and commodity beneficiary sectors than they do sectors that get hurt from higher oil prices. And there's been a buffer so far. You've had, consumers benefit from stimulus and tax refunds. There's been some drawdown of savings rates. Usually consumption doesn't get impacted until several quarters later. So consumers have held up okay so far, but obviously if, oil goes back above $100 a barrel and stays there for an extended period, then there's risk that has a bigger impact on the consumer and growth. So if stagflation risks rise, stagflation doesn't tend to be beneficial to equities. Equities tend to underperform other asset classes. But within equities, mid caps and small caps and value stocks have historically held up better than large caps and growth stocks during stagflationary periods historically.
Well, we just caught up with Mike Wirth, the Chevron CEO, and he said June and July is going to be, quote, critical. Jill, what does it look like for the consumer if we're seeing north of $5 a gallon in gasoline?
Right, and usually the impact to consumers does take about 3/4 for the oil shock to flow through and hit consumption, since as mentioned, usually savings rates get drawn down first, and the consumer was in good shape to begin with, and we've had that stimulus. But the longer that oil stays above $100, the bigger the risk is that as we get into the second half of this year, which will also be heading into midterms. So, if there's a focus on affordability measures and a focus on getting gas prices down, then obviously that will help the consumer. But we've been within our S&P 500 work. That was one reason we've been more positive on staples than discretionary. If we do see a continued focus on affordability, as well as just the fact that focusing on needs over wants, that staples could hold up better than discretionary if there is some weakness on the consumer side.
I cannot even begin to think about the politics of the midterms right now. Jill, thank you. Jill Carey Hall there of Bank of America. Let's worry about that later on in the summer. Maybe like the back end of the summer.
Yeah, don't ruin
September.
summer yet.
Right.
It's just starting to get nice
Let's
out.
address the situation in the Middle East and move on from that first.
I would agree with that. The issue is this really ties together. I mean, Mike Wirth is spending a lot of time in Washington, D.C. for a reason. Because as much as the market wants to move on, it hasn't moved on when it comes to the actual physical world, and that could potentially present an issue.
Happening right now in Reykjavik, Iceland, the economic conference. We'll keep tracking that for you right here on Bloomberg TV. Getting comments from the Fed Governor, Mickey Bowman. We'll bring you the headlines throughout the day right here on Bloomberg Television. Coming up on Monday, following the weekend, Aaron Canada, Clear Harbor Asset Management joins us. Torsten Slok of Apollo, Sharon Miller of Bank of America, Peter Cheer of Academy Securities from New York City this morning. Good morning. Who knows if this deal gets wrapped up this weekend or not, but thank you for choosing Bloomberg TV and have a wonderful weekend. This was Bloomberg Surveillance.